argue the labor market is as tight, if not tighter, than any we've seen in decades.
We're already in an economy that has seen peak growth on a quarter-to-quarter basis, and it's beginning to slow.
We're seeing a Fed that's moving a little bit faster, a little bit further to pull back on these purchases.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
It takes markets a long time to realize that something really fundamental has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market up 15 on the S&P, up a third of 1%. And just in a moment, Tom, we'll catch up with an equity market bull looking for 4,700 on the S&P 500.
We're getting these conversations in more and more, and the research suggests higher earnings, better, up they go on the equity market. And I would call today, John, a resilient market. Nothing really sticks out, but that's what you expect before a jobs report.
This week gets more interesting, Tom, as this week grows older.
Yes.
And let me tell you, that speech from Vice Chair Rich Clarida tomorrow, that's a big one after the division that's clear on the Board of Governors, with Governor Waller coming out yesterday swinging.
Right. Let's explain why this is, John, and this goes to our interviews that we've had with the vice chairman. Some of those interviews, frankly, rather heated. This is the great monetary economist of the leadership of the Fed. Powell is not an economist. Many of the others are very, very qualified, and Rich Clarida drives a theoretical bus at the Fed.
That's got to be the next stop for this market, Lisa.
Yeah, the Federal Reserve and how they're going to react to strong prints. My question, though, is are we starting to see a cooling off in some of the pressure, particularly within inflation? I mean, yesterday's ISM data really highlighting how supply chain disruptions are pressuring growth in a new way, John.
Should we get 10 cent up? Do you want to hit 10 cent quickly?
I want to hit spiritual opium.
What was going on? What was going on about that? There was an editorial, Lisa, that they pulled the link online to the editorial. This was the close over in Hong Kong, down 6%.
Yeah. Well, spiritual opium and electronic drugs. A state-owned media outlet of China included a criticism of video games as such. I mean, honestly, any parent who's lived through the pandemic welcomed spiritual opium and electronic drugs, which is the reason why we were all hooked to Fortnite.
I don't think you want to admit that on air, but carry on, please.
I think that if anyone does it, honestly, they're just being dishonest. A lot of parents are in the same boat, but there is a question. They're not wrong, but the idea here is that this is how they're going to indicate the next regulatory crackdown in this type of communication in state-owned media, and that is the response that you're seeing in equities.
We'll spend a little bit more time on this a little bit later. Let's get you to price action this Tuesday morning. Good morning. On the S&P 500, futures up 15, advancing a third of 1% into the bond market. Yields higher by a couple of basis points to 119.54. In foreign exchange, Tom, euro dollar 118.83. We're positive on that currency pair, a tenth of 1%.
Yeah, I mean, the markets again today are stasis, John, and that's normal into ADP and particularly into claims on Thursday. I'm just looking, John, at resilient equity markets and a dollar that, what's the dollar supposed to do? Strengthen? No, but it's resilient. It is really not weakened.
As yields are higher by 2 basis points on a session, Lisa, your 10-year 119.54.
All right, there's a lot of big data this week. However, there is some that's coming out today. And really the theme of the day, in my opinion, is a continuation of what we have been seeing. Supply chain disruptions, how much that is going to crimp growth on an ongoing basis. 10 a.m. we get U.S. June factory orders and durable goods orders. Yes, the demand is there. Are the supplies there? We are not seeing it in the same kind of way. How much are prices increasing? How much are factories competing for both the goods and the labor to get those goods in their doors? Then throughout the day, this is the other aspect of the story. We're going to be getting U.S. July awards, total vehicle sales sort of trickling out. And here we're going to see also supply chain disruptions and, frankly, auto chip shortages, which we heard from BMW overnight. These are all things that are adding to an outlook that is highly uncertain for automakers, even though you have incredible demand and incredibly high prices for cars. Anyone who's tried to go buy one, anyone who can drive, can actually go and see how expensive some of these cars have gotten. And then 3:45 p.m., President Biden is planning to speak on COVID-19, the progress of vaccination in the United States. Right now, the surge in Delta is getting increasingly concerning. In Florida in particular, just to sort of pinpoint one example, which accounts for 20% of all the diagnosed new COVID cases over the past week in the United States. Hospitals are seeing constraints. They're seeing labor shortages. They're seeing nursing issues because their crowds are just overwhelming. This is what people are looking for to determine what the next steps are and how critical this is going to get, John.
Lisa, thank you. Let's turn to the price action. An equity market bull looking for 4,700 on the S&P 500, raising his price target from 43 in the past 24 hours. And I'm pleased to say that John Stolfus of Oppenheimer Asset Management, the chief investment strategist, joins us right now. John, help us out. How do we get to 4,700 and why the upgrade?
Well, I think, Jonathan, first, thanks for having me on the show. Tom, great to be here. Lisa, great to be here as well. Just to let you know, when we look at it, it's that resilience of equities that we're seeing, the fact that we've got earnings momentum here, that even as the dramatic comparisons begin to ebb in the third and fourth quarter, will still show that companies are maneuvering very uncertain times. A lot of it done by, of course, use of implementation of technology and the innovation that comes with that.
John, how far out can you go when you look now at a guesstimate forward for equities? Can you go out 6 months with confidence? Can you go out 1 year with confidence? Can I get you out 2 or 3 years and Standard & Poor's 5,000?
Tom, I won't do 2 or 3 years out, but I can do 12 to 18 months. We feel pretty comfortable with the momentum of a $20+ trillion economy in the U.S., the resilience that has been the result of the Fed rescue program, and probably an overabundance of fiscal stimulus tells us that we've got a further upside here.
Lisa, that 18-month statement by Mr. Stolfus, I think, is a huge deal. There's very few people with that courage.
Yeah, the idea here going forward, it's going to be very difficult to have visibility. And, John, one of the aspects of that visibility is supply chain issues, which we keep seeing in reports from companies, in particular the auto companies that we're going to see throughout the day. Have you factored this in? How do you factor this in? What's the time frame for when we stop talking about this?
Well, I think, Lisa, we have to take this in context. And the big problem is when you're coming out of a major crisis, you get these periods of uncertainty, but you have to take a look at and you see how things have been done recently. Just think back where we were a year ago or in March or April of last year. Everybody was projecting very negatively because things were so uncertain. I go back to 2009, and as an early bull in 2009, what played out was the fact we looked and saw what the Fed was doing. We looked at corporations that responded positively to it, the strength of the consumer. All that gives you confidence in looking forward that we are likely to be headed towards an economic recovery that turns into sustainable economic growth in the U.S. at a modest enough pace so that interest rates don't rise so much to overthrow the equity market. Give it a jolt. There's always pullbacks, and mini corrections, maybe even a correction ahead. But the overall story is resilience. Tom said it. It's that resilience, and it's a factor that is backed by fundamental structures in the global economy, not just the U.S., but particularly in the U.S.
That sounds like a bedtime story for the equity market bulls, all right, John. That'll help them sleep nicely. Let me talk to you about something that's keeping some people awake at night, and that's the Delta variant. This is what Morgan Stanley had to say over the weekend. In the UK, a reasonable template for the US. Hospitalizations remained low as cases spiked. The economy reopened anyway, and ultimately cases have started receding, suggesting overstated downside risks from COVID-19. Do you think, in the words of Morgan Stanley, that is a reasonable template for the US, John?
I think it likely is, though. We've got to say, when you if you'd asked me what the biggest risks are here, we would say number one is the variant, and the fact that we still don't have enough people vaccinated in the U.S. with a second shot. In addition to that, the second thing would really be overstimulation by politicians in Washington that could bring about longer-lasting inflation, though we don't think the type of inflation that we saw in the late 70s or early 80s, which both Tom and I experienced, by the way.
Oh, thank you.
John Stolfus, Oppenheimer Asset Management Chief Investment Strategist. I'll invite you back, John. Don't worry, even if Tom doesn't. It's going to catch up, sir. Looking for 4,700 on the S&P from 4,300 previously. Your equity market with a lift this morning, up 16 TK. We advance about a third of 1% on the S&P.
A third of 1%, and you wonder where M&A activity goes here, John. Ford, just out, Dow Jones has this. This is PepsiCo jettisoning, John, the juice business. John, do you drink juices like, in America we used to have a glass of orange juice every day?
A lot of sugar.
It's
in
gone.
some of those juices.
It's gone. Pepsi
so this is Tropicana.
Gone.
This is the naked juice brands.
Yeah.
The juice brands valued at roughly $4.5 billion. Is that a trim for the likes of PepsiCo, Tom?
Yeah, I think it is. That's a nice way of putting it. To PA partners with their heritage with Paribas of France. It's European private equity. But, John, this is important for the surveillance team. I mean, there was a period, John, in the 70s where you had to choose every morning Tropicana or Tang.
Yeah, this sounds really personal. This sounds really personal. Can I talk about something a little bit more personal to the Federal Reserve and Chairman Powell, maybe? And that was Governor Waller yesterday on CNBC saying the following. I think you could be ready to do an announcement by September. That depends on what the next two jobs reports do. If they come in as strong as the last one, then I think you have made the progress you need. Lisa, that really advances this story that maybe Payrolls Friday, this coming Friday, is a little bit more important than it might be for the likes of Governor Brainerd.
Well, and that seems to be what Chair Powell was indicating as well during the press conference. The question just is, in my mind, and you've repeated this again and again, John, which is, what is the market response? If we get a very strong jobs number, is that positive or is that negative for bonds, given the fact that a sooner hike, a sooner taper might crimp growth in the long term?
No idea is the answer to that. 875 is the estimate. I can give you that, and I can also tell you that's a moving target going into Payrolls Friday. Our current median estimate down from north of 900K, Tom, coming in at about 875 a few days out.
Yeah, after what we saw May 7th on the April report, John, I don't look at any of these surveys with any kind of belief. What's the standard error, John, after what we went through May 7th?
Well, let's talk about the range. It's anywhere from in and around 350 to well north of $1 million.
We're going to cover it. That's what I know.
Deep into the unknown, and that's what I know too, Tom. Full coverage coming up this Friday on Bloomberg TV and radio. Equities up 16 points, up a third of 1%.
This is a Tang
We
show.
both know you don't start your day with orange juice. In the bond market, yields higher by a basis point or two, 119.38. From New York City, Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are indeed safe. The British government is seeking to limit disruption to industry from the so-called pingdemic. Authorities have changed the National Health Service's COVID mobile phone app so that fewer people will be told to self-isolate. The app will now notify only those who come into contact with an infected person within 2 days prior to the positive test. That's instead of the 5 days. A key Senate Republican has tested positive for the coronavirus, and that could delay those Democratic plans to pass that infrastructure bill this week. Senator Lindsey Graham and at least 4 other senators attended an event over the weekend hosted by Senator Joe Manchin. Graham will quarantine for 10 days and miss votes on the legislation. If other senators test positive, that could delay the vote timetable. And at the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to the competition and won the bronze medal in the balance beam final. That came just a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What we've learned in the intervening months is that demand is indeed very strong, but there have been some pretty severe supply side constraints. People are not flocking back into the labor force in the numbers that we had hoped. For the reasons that everyone suggested: health concerns, childcare issues, and the supplemental unemployment benefits.
Stephen Stanley, Amherst Pierpont chief economist, looking for the first rate hike at the Fed in June of next year. I posed that to Mike Schumacher of Wells Fargo. He said he's got the month right, the year wrong. There you go. Just one view. Tom Keene, Lisa Abramowicz, Jonathan Ferro. Or rather, two views, Tom. That does nail it. Equity futures up 17 on the S&P 500, advancing 0.4%. Into the bond market, yields higher by a basis point or two to 119.21. Euro-dollar firmer by a little more than a tenth at 118.88. Just want to bring you some comments from the St. Louis Fed president, Jim Bullard, telling Reuters that the Fed will have to cope with faster change, a more volatile economic regime emerging in the United States. And in many ways, it seems that the St. Louis Fed president is on the same page as Governor Waller and former head of research of the St. Louis Fed, Tom. Those two look like they're building a partnership on that Fed.
I would suggest, John, they're slaves to the data like everyone else. And we've got to see what the data is, starting with the key Friday determinant and also the wage dynamic of that. Frankly, the auto data will be interesting, even with the chip shortage. And it's just, John, it's a granularity of data that we're all going to have to digest.
Euro-Swiss making a move, Tom. Just to bring that up quickly, a headline cross on a Bloomberg. Euro-Swiss, lowest level this year. So that's some Swissy strength in the mix.
Yeah, and this is Swissy strength. And John and I tear up over this, folks, because this is how John and I met, was with Swiss franc moving here. And you know, it's demonstrable.
There's a bar
John,
bill involved, Lisa. You won't be surprised with that.
I'm shocked.
Euro-Swiss right now, 1.07. It's a move of a tenth of 1%, but a gap lower in the last 10 minutes, Tom.
Well, there it is. Let's go to Washington right now. And what's so fascinating about what we see in the news, so yes, infrastructure front and center. There is the sign always in the summer when one topic overtakes all in Washington. Anne-Marie Horton knows that is the E word, eviction. Anne-Marie, how did we get here? How big a surprise on a summer Tuesday in August is that there's no other topic in Washington but the eviction of millions of Americans?
Tom, there's a lot of finger pointing here in Washington about this eviction. The White House last Thursday telling Congress you need to act before it expires in just 48 hours. But really, it's not a surprise given the fact that the end of June, the Supreme Court had said this. So Washington had about a month to decide what it wanted to do and how to proceed. And right now, there's just a lot of blame going on and who should be responsible. The White House says it just doesn't have the legal authorization to act alone. Brett Kavanaugh, who actually voted with the progressives of the Supreme Court, that Justice Kavanaugh also put out a memo saying they have a month to the extension, and this should give the state and local authorities enough time to tap all of that funding, $47 billion worth for rental assistance, to help with these evictions. But right now, millions are facing eviction, and the White House is really just trying to hammer home how these state and local authorities could get that money out to landlords and renters.
Anne-Marie, let's talk about the infrastructure bill and the senator from South Carolina, Lindsey Graham. Senator Graham testing positive for COVID. We, of course, wish him the best and for a full, speedy recovery. Anne-Marie, how does this reshape, if any way at all, reshape the infrastructure talks and the passing of this bill?
Before the logistics, John, we also should note that the good news is that Senator Lindsey Graham also said on Twitter that without the vaccine, he is sure that his symptoms would be far worse. So he does feel like he is dealing with some minor symptoms. He was on the weekend gathering with other senators on Senator Joe Manchin's houseboat. So there is this cloud of worry that potentially there could be others that test positive. And unlike the House, the Senate does not have a proxy vote. So if he's in quarantine, he wouldn't be able to vote for the upcoming legislation if it was to hit the floor. That's potentially one key issue. Also, the fact that he was part of that bipartisan group, a very loud voice trying to push this through and also getting other Republicans on board. So there's a lot of interesting facets at play when it comes to this, because without his vote, potentially it could go through, but will other Republicans join in? And also, what does it mean for other breakthrough cases on the Hill?
Anne-Marie, what happens if they do not pass it before the August recess?
Well, what happens is potentially two things. They go home and just deal with it when they come back, Lisa, or what Senator Chuck Schumer has said potentially is that they work through August recess. There, in essence, is no vacation, and they will work to get this infrastructure bill through.
I'm just digesting. In essence, there is no vacation.
I thought you were in shock, Tom, because I just saw reports coming from London that Harry Kane was absent for training again.
Oh, dear
Yeah,
Lord.
well, I've been looking at that
Second
as well.
day.
I mean,
I thought you were
there's
distracted.
a lot going on here that we're distracted by. But Anne-Marie, I look at the infrastructure bill and all here. What does the end of your week look like? I can't get a clue on the actual zeitgeist of the end of the week in August.
It's very difficult to see what the end of the week will look like, because every day there are these wild cards. For instance, yesterday, Senator Lindsey Graham getting COVID. The fact that you now also have this eviction moratorium obviously taking a lot of the space of the discussions that are happening in Washington. You have Treasury Secretary Janet Yellen will be speaking to House Democrats today about the eviction moratorium. All of while they are trying to get infrastructure through. They want amendments on the floor. Senator Chuck Schumer wants a vote by the end of the week. We'll have to wait and see if he's going to get it.
Anne-Marie, good to catch up. Anne-Marie Hordan, our Washington correspondent down in Washington, D.C. Are you read in now, Tom?
Yeah,
on what's happening in North London?
I'm right in. There's like so much going on here. I mean, come on, John. How can he abrogate his contract?
It's what Lisa does every morning. Threatens to sit out the show to force a change of shows, Tom. She wants to get to a different program. Maybe around lunchtime. Hates the early starts.
Okay, John, full disclosure, I was not read in on 10 Cent and the opium of games. Lisa and I have been going back and forth. And, John, it's the pendulum of Parcheesi. These kids have got to get off their games and get back to real board games.
Okay.
In the summer, you waste an entire day playing Parcheesi.
Lisa, the floor is yours.
I've spent so many hours playing Parcheesi that I'm cross-eyed.
Can you let me know what Parcheesi is? Because I have no idea what it is.
It's a board game. You try to get your pieces into the home base, and you've got 4 or 5 pieces depending on who you play with.
And this is what the boys play?
They did, and then the pandemic hit, and you outsource parenting while you try to work to video games, which is an opium or drug or whatever the Chinese official media. They're not wrong. We just try not to talk about it too loud.
John,
regulatory fears in China, though. The fact that got pulled so quickly in the online edition, anyway, Lisa, speaks to maybe the reporters there going a little bit too far. That's what I've heard from the team here at Bloomberg this morning.
I wonder how coherent their effort is, how much they understand what the ramifications of their words, I'm talking about Chinese regulators, will be on markets, how sort of calculated this is, because it feels a bit haphazard, if you will.
I'll catch up with Wei Li of BlackRock, and Wei Li's pointing out that she doesn't think this stops anytime soon, but she thinks the effort will fluctuate over time, and that they'll soften the blow here and there with a loosening of policy. On the economic side, at least, and that's something we need to get our teeth into. Let's get our teeth into this market, Tom. The S&P 500 with a lift up 0.4%. John Stoltzfus of Oppenheimer on this program 25 minutes ago. TK looking for 4,700 on the S&P.
Stoltzfus is, bullish. He's been bullish. He's had the courage to be in the market. Also, Stoltzfus played Parcheesi, so that's a good thing.
43.87 was the close on the S&P yesterday. This show, seriously, from New York City for our audience worldwide, a beautiful New York, on TV, on radio. This is Bloomberg. Live from New York City for our audience worldwide, here is the Tuesday morning price action. Good morning to you. Equity futures advancing by about 1/3 on the S&P. On the Nasdaq by a little more than 1/10. The small caps outperform, up 0.7%. John Stoltzfus and Oppenheimer on a show 30 minutes ago, looking for a move to 4,700, an upgrade from him in the past 24 hours from 43. The call is on the fundamentals. So let's talk about the fundamentals and this market. Switch up the board and get to the bond market. 2s, 10s and 30s. BMO for me with the line of the past week. How much this Treasury market trades on the fundamentals is as much of an unknown as the fundamentals and the incoming data itself. Your yield right now, a breakdown yesterday, 119.21. Yields are higher on the morning by about a basis point. They are well off the highs of the year of pushing 170, 180 on a 10-year at the back end of March. Right now, 186.38 on 30s. The real question for me at this point is, can you really look at a Treasury market in a vacuum focused purely on the fundamentals in one country when this is happening elsewhere? Switch up the board and get to the Bund curve. 2s, 10s, 30s. Every single part of this bond market in Germany yesterday was negative.
Yeah.
With the 30-year yield below that zero line, Tom, for the first time since February, and right now 0.005%. I just don't think you can, and many people agree, because it's just stated the obvious. You can't take the Treasury market and say it trades purely on the fundamentals of the U.S. economy when you've got this happening everywhere else.
John and I channeling this morning. I look at the Swiss 20-year as a proxy on that. And, John, what's so important here is they're really buttressed about good, new lows, new greater negative. It's a little bit different than what we see in the United States.
Yeah, just breaking down over in Germany. And, Tom, we were talking about maybe getting closer to zero on a German 10-year, and we're back to negative 47, which is basically in line with the policy rate of the ECB of negative 50 basis points.
It speaks to the economy's under view here. And, of course, jobs on Friday will give us the American view, a real update there. Right now, on that report, Joseph Livornia joins us with Natixis CIB, their chief economist for the Americas, in his public service at the White House recently. Joe Livornia, I want to talk to you about the mystery of this August, the mystery into Q4 as well. How opaque is your Q4 right now?
It's somewhat opaque. Look, the economy's done very well in the past 4 quarters. GDP growth has been over 12%, but I've been of the view that the economy was at peak growth around Q2 and things are going to moderate. But even so, Tom, it's hard to see growth still not being really robust in the fourth quarter. I'm more worried about growth in 2022, and that's what the U.S. Bond market and global bond markets are sensing, that growth is going to weaken quite sharply with this bull flattening. And inflation will be transitory. That's what the markets are telling us.
That's what the markets are telling us. And is it a weakening back to potential GDP, or let's say 3%? I mean, what's the level of weakening, the scale you would presume?
This year growth, I thought coming in, we'd have growth at 7, maybe even 8%. But next year, I'm thinking growth is only 2%, maybe even less. Wow. Which isn't far from the administration's longer-term forecast. And that reflects the fact that we're borrowing from the future, because we've had people that have been unable to spend until recently because of the pandemic. They've been locked up. They brought spending forward. We see that in goods purchases, which are about 4 to 5 points above their long-term GDP trend. And it's been predominantly consumption-led. Consumption in the last 14 quarters, if you look, or 14 months rather, Tom, from when the savings rate went from 34% now down to 9%, we've had annualized consumption gains of 21% real. That's amazing. It's mostly in goods. So we're borrowing from the future, and that's why growth next year will slow quite sharply.
Joe, let's take your view of the world, and I'll ask you a basic question. How do you think the Federal Reserve operates in the kind of environment that you've just described?
They don't do anything, Jonathan. They stay on hold. They continue to pump liquidity in the system. They don't taper. They don't tighten. What we've seen continually since those late March, early April highs in 10-year yields is the market pricing the terminal rate significantly lower. That five-year OIS we've talked about was around 240 back in early April, thinking the market would basically, or the Fed rather, would tighten rates like they did in the last cycle. And just the other day, we were below 150. So the market's thinking the Fed does nothing. Yeah. And my guess is we don't get a tightening until after the next presidential election.
John, and then this goes right to the heart of what you mentioned before, which is the gentleman from St. Louis disagrees, just flat out disagrees with Joe Livornia.
As does the former head of research, I imagine, over at the St. Louis Fed as well. Joe, you said
That's okay.
no tightening.
I don't mind being the other side of that trade.
I imagine you don't mind that at all. You said no tightening, no tapering. You don't think we get a taper here, Joe, at all?
Not until we know what the contours of a budget deal look like, because the Fed will treat a lack of a deal as being contractionary. And even though we're in the midst of debating what happens on the infrastructure side, the bigger part of the package is this family welfare bill. And we're not going to know what that looks like if we get it, and it will likely be through reconciliation until maybe mid-October. Early November. So, no, I think the Fed's going to sit and wait, see how things evolve. And it's going to be really hard, Jonathan, for the Fed to taper in a slower growth environment, and especially if over the next few months job growth slows, which I expect as well.
Just fascinating. Joe and Lisa, this won't be lost on you. No tapering. The other call there, no rate hike until after the next election.
Yeah, I just want to add one other thing. That sounds aggressive, but if you look at the last 2 cycles, the average time from the last rate cut to the first rate hike was 7 years. So this isn't really that unusual if you look at the last couple of cycles.
So, Joe, why are some people wrong who are saying that the balance of risks is too much higher inflation, especially with the Fed so dovish and so willing to wait? What is wrong with that call? Because it seems like you disagree.
Yeah, well, the thing is, we've never had basically a global lockdown of the economy where we've gotten these bottlenecks, and of course, demand has been much stronger than people expected. The government has provided a tremendous amount of assistance, so it's easy to see why prices are rising. If there's a concern on inflation, and if I'm wrong on inflation, it's because perhaps we just spend too much. This is sort of the Larry Summers argument. And maybe evidence of that is seen in what the CBO next year was saying the output gap looks like. They're forecasting an output gap of almost 240 basis points, meaning the economy is 2 points above its long-term potential. That's the highest since '71. So it is possible, if we get more fiscal stimulus, you could build this inflation dynamic in the system. But I think most people just aren't fully appreciative of the unique situation we're in, and the fact that much of the liquidity we've had to this point has gone into assets, both equities and, of course, real estate.
Joe, I hate to use the word transitory, but let's talk transitory. And at what point you start to look past some of the near-term influences on the economy? I'm talking about supply chain disruptions. The gentleman from St. Louis, as Tom said, was highlighting this as one feature that forces monetary policymakers to be more nimble. How do you factor in some of these disruptions that seem overly persistent and persisting longer than many people had expected?
Yeah, I would just say, I would just give it time. I mean, the thing is, we saw with lumber, for example, which was the poster child for bottlenecks, where prices have basically collapsed as the mills were able to reopen. And I've argued we're going to see that more on the semiconductor side and other parts of the economy. It just needs to take time. The expectation side of it's important. And when we look at the tips curve, that tips curve is actually inverted. So it's not to say the markets are always right. There's just no evidence that anybody believes this is permanent. And because expectations oftentimes can be self-feeding and self-sustaining, those expectations are very likely to keep inflation low. And then as supply comes on, you'll start to see those prices moderate.
Joe, none of this is in the economic textbooks at Vassar. This is all absolutely original that we're dealing with right now. How do you interpret the real yield? Are you looking at the nominal rate? Or are you taking out the inflation expectation? Which of those two dynamics will adjust the real yield?
Well, I would say just focus on the real yield. The real yield has been falling as inflation expectations have edged up a bit. And that's sort of evidence, Tom, right there. The market does not believe that you're going to have very, very strong growth going forward. It's I hate to say these words, but it's the secular stagnation thesis. That's really what the market's saying. And you see it more broadly just in the slope of the curve, as you highlighted, both in the U.S. and Germany and elsewhere. You've got a bull flattening of the yield curve. So that's really not an inflation story. It's a growth story. And of course, equities benefit from the fact that there aren't any alternatives, and there's a tremendous amount of liquidity in the market.
Joe, fantastic to catch up. Some really interesting calls there. Joe Livornia, really good to hear from you, sir. Natixis CIB, Chief Economist for the Americas. Within 24 hours, we've had two widely different views. Stephen Stanley of Amherst Pierpont looking for the first hike of June next year. And then you've got Joe Livornia there, Tom, talking about no hike through the entirety of this first administration from President Joe Biden.
Yeah, well, and it's the in-between that's of interest as well, John. I just think it shows where we are and how original this natural disaster is that we're living. And I'm sorry, I'm not into giving an opinion here in any way, shape, or form. We don't know.
Following the data, and I have to say highly anecdotal, but some of the signs that came out of yesterday's ISM, slightly encouraging in the industry commentary that we got, Lisa. This line stood out for a lot of people, at least. Supply chains are slowly, very slowly filling up, like a water hose starting upstream and slowly flowing downstream. Rumour is a full return to normal, maybe nearer to year's end, but the situation is progressing. We need to hear so much more of that through the next several months.
You also saw a moderation in how much prices were going up. Just to speak to that point, this idea that some of these pressures do seem to be moderating and really speak to Joe Livornia's point, which is that these issues are temporary. I do just want to say, though, that it all depends on inflation, what you think the Fed will do, and whether we're in a new regime or we're going back to an old one, where it's a series of lower lows when it comes to the neutral rate, just based on how much debt there is, John, and how much there is to risk if you raise rates too quickly.
Well, clearly, Joe thinks we're going to be waiting, Tom, a long, long time.
Yeah, I wait a long, long time. I mean, I don't think that really outlines what he said, John. A long, long time for Joe Livornia is an outlier.
Through 24 and into 25. Look, we went there last time around, didn't we?
Well,
took
that's
a long
where we've
time to
been.
wind things down.
Come on, it's a great missed call, John. It's a great missed call of the last number of years.
Well, look, Tom, the issue
now.
that people are raising this time around is that we have a set of policymakers conditioned by the previous cycle who are implementing policy based on the mistakes they made previously for a cycle that is radically different and moving at a very different pace. That's the argument anyway.
When yields broke yesterday, you and I were looking at 2-10 spread to go to 0.99. I mean, that's where we are.
Yields right now still sub 120 on 10s, 119.71. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures up 17. We advanced 0.4% on the S&P. In the FX market, euro-dollar firmer by about 0.1% and change to 118.86. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state, and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach many enthusiasts would like to see. He says that investors must be protected against fraud. A Labour union may get the chance to reverse its loss to Amazon. Bloomberg's learned that a federal official has recommended overturning the results of a union election at an Amazon warehouse in Alabama. The National Labor Relations Board hearing officer says the election should be run again. Amazon can appeal that decision. The union accused the company of making anti-union threats. And Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. Standard Chartered's bottom line was boosted by reduced credit losses. Meanwhile, the wealth management unit posted a 26% increase in operating income. In China, shares of Tencent fell as much as 11% today. An offshoot of China's official news agency referred to video games as spiritual opium and electronic drugs. That stoked fears that Beijing will next set its sights on online entertainment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We want to strongly recommend that people wear masks in indoor settings, even if you're vaccinated. Now, this is particularly true, of course, if you might be around anyone unvaccinated.
I believe it's in your business interest to run a vaccine-only establishment. It's very simple. You can operate a restaurant and just say you have to show that you were vaccinated when you walk in the door.
New York City Mayor Bill de Blasio and New York Governor Andrew Cuomo on a difficult moment for this country. Another shift in the past week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market, the S&P up 0.4%, advancing 16 points. Into the bond market, yields higher by a couple of basis points. Still sub 120 at 119.54. And the euro trying to get back to 119 again. Euro dollar positive, almost 0.2%. TK euro dollar 118.89.
Yeah, I like watching euro there one night. You know, through 119 is a big deal, John. A test of 120 would be a huge deal. The other thing I'd note here is the VIX 18.69 shows a stasis before the American labor reports of Wednesday, Thursday, and Friday. This is an honor. Christopher Bayror is someone who puts travel to work out of Hobart and William and Smith College ages ago and downstate. He holds court at Johns Hopkins in the Bloomberg School of Public Health, is a lead epidemiologist. We're thrilled that Dr. Bayror, with his international perspective, could join us this morning. Let me go local if I can, Dr. Bayror, which is the idea of the mayor of New York City and the governor of New York State saying, public enterprise, get your act together. Is there a history in a pandemic that public enterprise can provide public health policy?
Well, you know, what we really, of course, want to see is the federal government leading on this to have consistency across the states. But we've never had that in response to the coronavirus. And so I think what you're seeing is that People are reluctant to speak to the need for national mandates on masking, on immunization. And so it really has been up to much more local entities and the private sector to step in. I think what you're seeing is that we know these vaccines are highly safe and effective. These are the vaccines with emergency use authorization. And our only way out of this is much higher immunization rates than we've been able to achieve. But in the absence of doing better on vaccines, we are going to see things like vaccine mandates in the private sector.
If a senator, Mr. Graham, if a pitcher, Mr. Cole of the dreaded New York Yankees, if they get COVID, but we rationalize that they'll be fine, how does that fit into this mix?
Well, the important thing to remember is that these vaccines are holding against the variants in terms of hospitalization, pneumonia, death. But as it turns out, people who've been immunized can still get COVID, as Senator Graham did. And unfortunately, it looks like they can also transmit it. So they're likely to have a mild, much attenuated course, but still to have it. What that means is masking is still important. The senator is self-isolating now for 10 days. That's the right thing to do because he could very well be infectious for others. What's not happening is that he's not getting pneumonia and he's not in the hospital. When we look at who is in the hospital and who is on a ventilator, it's overwhelmingly the unvaccinated. And that's a tragedy.
Dr. Byrer, we've heard from Tony Fauci of the National Institute of Health that we're probably not going to see additional lockdowns. And yet in Florida, we're starting to see constraints on hospital staff as they deal with a surge in intake and patients coming in their doors. What's the potential threshold at which point this becomes a public health problem once again? We don't want to go back to a time when you're starting to set up tents and hospital beds outside in order to deal with the capacity.
Well, we were down to about 12,000 infections a day. We're now back to 80,000 infections a day. And that is largely because of this much more infectious Delta variant. We had seen really a stalling in the vaccine effort, but it has been picking up in the last 2 weeks or so. Fortunately, people are really starting to move. As far as lockdowns and shutdowns, I think Dr. Fauci is generally right. But the exception to that is likely to be where vaccine coverage remains too low, places like Florida, other states in the South. We've already seen Missouri and Arkansas with low immunization coverage having high hospitalization.
Yeah. Dr. Byrer, the emotional effect of going back to wearing masks was actually greater than I thought. I was speaking with my colleague here about that. A lot of people wondering, are we going back to an era that seems endless the way it did a year ago? And there's a question, how long has the pandemic been prolonged as a result of the Delta variant?
Oh, there's no question that it's been prolonged. It's not just the variant. The reason that these variants can emerge is because there are so many susceptible people out there. And we have to remember that as challenging as this is in the US, in much of the world, there's virtually no efficacy, no high efficacy vaccines available. People are using the Chinese vaccines, which are not holding up well against this variant. They're using AstraZeneca, which also doesn't hold up as well. So what we really need is high efficacy vaccines with high uptake. Otherwise, we're going to see more variants. There's already a new Lambda variant that is emerging that may be a variant of concern. This is going to keep happening as long as there are so many susceptible people. So our way out of this is to do much better with immunization and to do much better with the high efficacy vaccines, the mRNAs and the J&J.
Doctor, just quickly, is the experience of the UK in the last couple of months a decent template for the United States?
Well, I think you're seeing there, Britain is already thinking about and moving toward a booster because of concerns about waning immunity and the need to protect the population. Apparently, China is also looking at boosting with an mRNA. Israel is planning on looking at a booster.
The reason I ask that, of course, Doctor, is because cases have rolled over quite significantly over the last couple of weeks. And that's what I mean by saying, is the UK a decent template for what we might experience here in the next several weeks through August?
Well, it certainly could be for much of the country. The immunization rates have been high in the UK. We still have areas that have much lower rates of immunization and where the UK might not be a good template, like Florida.
Interesting. Doctor, appreciate your time, sir. Thank you. Dr. Krista Byraw, Johns Hopkins Bloomberg School of Public Health professor and epidemiologist. Your equity market looks like this, up 16 on the S&P, advancing a third of 1%. For the market strategists out there, Tom Keene, there are many, including Morgan Stanley, who look to the UK as a template for the United States. And for that very reason, many people in this market still constructive about the near term, because of exactly that.
Yeah, well, I think the constructive wing is tangible in the developed world. It's still there. But to me, John, it's news day every day. And I think the significance yesterday of Mayor de Blasio and Governor Cuomo reading the riot act to the restaurant business to get their act together, vaccinated, unvaccinated, was really critical, certainly for the Eastern Seaboard.
Do you think the mayor of New York City has a decent relationship with private organizations, private companies, Tom?
Oh, it's
to
phenomenal.
Try and make that happen?
I think it's sterling. I think it's a sterling
you think it's
relationship.
Good enough?
Yes.
The sarcasm.
Isn't that sad, though, that for the moment we're in right now, Tom, that relationship would really matter. It would really count, and it hasn't been built up. Lost for words. Okay.
Silence.
You tell me in a commercial break what you really think. Tom Keene, Lisa Abramowicz, Jonathan Ferro. Joining us shortly, out of hand of Wells Fargo. Equity futures up 16.
We should get a Parcheesi
advancing
board.
4/10
really?
of 1%. On the S&P 500. John Stolfus of Oppenheimer looking for 4,700 on the S&P. From New York City this morning, good morning. This is Bloomberg.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
We're already in an economy that has seen peak growth on a quarter-to-quarter basis and is beginning to slow.
We're seeing a Fed that's moving a little bit faster, a little bit further to pull back on these purchases.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
It takes markets a long time to realize that something really fundamental has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market up 17 on the S&P, advancing 0.4 of 1%. We've had a little look at 4,400 over the last month or so, Tom, on the S&P. The calls keep coming through, 4,700 from Oppenheimer in the last hour on this program.
Well, the lift is there, and that's a measured lift out, a measured amount of time. Of course, 5,000 is a big figure for Standard & Poor's 500. John, a Dow equivalent to SPX 5,000 is just under Dow 40,000. Call it 39,500.
Thanks for that value add.
But seriously, John, nobody's framing this. Nobody's framing out beyond Q4, maybe summer of next year.
Well, let's frame the debate right now. We had a guest on this program yesterday, Tom, Stephen Stanley of Amherst Pierpont, saying first hike June next year.
Yep.
We had Joe Lavorgna of Natixis on this program 30 minutes ago saying first hike, it's not going to happen through the next 3.5 years. They are radically different calls, and both individuals are looking at exactly the same economic data.
You fold that into the markets, John, into the rate market where money's made and lost, but particularly into the equity market. And it's a vision thing that surveillance is struggling with now here to the end of the summer. And I would say into autumn. We got to get through August, but then how do you frame June of next year? And the answer is, if you're a bull, you go to SPX 5,000.
Yeah, I kicked off yesterday by kicking off the month of August by saying, Lisa, this is the road towards September. That's all August is.
Yeah, although you hear from Fed officials that maybe September is the road to October when we get the data for September.
If you're Governor Brainerd, yes.
I mean, that's the issue, is at what point do you have a world that you can look at and actually assess? And really the key metric here is inflation. People wondering, and really the dissonance that you're seeing on the sides of a rate hike next year or a rate hike in 3.5 years is, are we going to get a new inflationary regime post-COVID, or are we going back to the old regime and then some with the load of debt that we have hanging over us?
Is it fair to say the week starts tomorrow? Vice Chair Clarida, Tom, coming out tomorrow with a speech. ADP report claims Thursday, payrolls Friday.
No, the Clarida speech has got to be there, because is he going to put Bullard in the timeout chair? I mean, that's what this comes down to.
Does he bring Jackson Hole alive again after Governor Brainerd poured some freezing cold water over it over the last week, too?
John, are you selling you need a trip out to Jackson Hole?
No. I won't be around for Jackson Hole. Your equity market up
Lisa,
16 on the
cowboy hat.
S&P.
Imagine it
S&P
on
500
radio.
futures
Ferro and a cowboy hat
at
and
4/10 of
Tony
1%.
Lamas.
Nobody needs to see that. Yields are higher by a basis point or two to 119.21. And euro dollar, Lisa, having a little look at 119 again, up 1/10 of 1% on that currency pair. Euro dollar positive. The euro 118.85.
John, that was kind of ominous. I won't be around for that. I mean, you're going to be on vacation. It's not a serious thing, unless you want to go.
I'm not as dark as you. No one took it that way.
All right, let's move on.
Please do.
10 a.m. We get U.S. June factory orders and durable goods orders. Interesting to see the demand from factories. Also, whether we start to see some of the inventories build up, whether orders continue to be strong. Really, again, a key measure on some of the supply chain disruptions. Are they starting to ease in tandem with what we saw yesterday in the ISM manufacturing survey? Let's not overstate it. Easing a little bit, but still a good trajectory. Also today, throughout the day, we're going to get U.S. July awards, total vehicle sales. The key issue here is how much are they slowing because of a lack of inventory on dealership lots. And this has been a theme. We hear that the road ahead is going to be rocky because there continue to be auto chip shortages. Is there any sign of that rolling over? Also, what are some of these sale prices like? This is what's kept profits very high despite some of the shortages that we've seen. And 3:45 p.m., President Biden is planning to speak on COVID-19 and the pace of vaccinations throughout the country. Interesting to see what he says about mask mandates, also trying to pressure the private sector, John, to take a more active role in mandating vaccinations for access. We see them looking to the private sector to take the lead role, as frankly, it continues to be a mystery as to what the legality of a federal mandate really is.
Lisa? Really important stuff still ahead of us. Thank you. We talked yesterday about the comments coming from the team over at BMO on the bond market. The extent to which treasuries will be driven by the fundamentals is as much of an unknown as the actual data itself at this stage. This is the line from Wells Fargo on the economic data. Economic data continues to be in the eye of the beholder. Anna Han joins us now, Wells Fargo Securities equity strategist. So, Anna, let's talk about that. What does it mean for an equity investor, the incoming economic data of the moment?
I think what it means for us is that it can be interpreted sort of how you want to see the picture. In the eye of the beholder, what I mean by that is that sometimes you look at this economic data, you can be really concerned. Is growth slowing down? Is the amplitude of future economic GDP growth slowing down? Will that extend the cycle? And in that case, is that a concern on why maybe real yields are pulling back? Because people have a concern about whether full employment can be reached sooner. On the other hand, there are a lot of still bright spots in that economic data that support this reflation trade. I think it depends which camp you're in.
Anna, your research note is fascinating in its physics where you talk about amplitude. I want to take it over to an even larger idea of magnitude. For the bulls out there in the equity market, what are the magnitudes that get you out to the emotion of SPX 5000 or the emotion of Dow 40,000?
You know, those are big, beautiful, round numbers, Tom, and people love those shiny numbers. I think to get there, what you really need to see, maybe two fronts. One is that when you have these kind of yields retreating, you see this kind of natural effect for a discounting model for equity growth, for equity earnings. But on the other hand, that comes with this sort of ominous side of, well, growth is slowing down. Is it sustainable? But to get that yield, people may be reaching into equities. On the other hand, to really push equities, and I think what's been driving it more recently is expectations and estimates. As we've gone through earnings season, you've seen corporates very focused on what do these input costs mean for my margins. And for the companies that are able to pass along that price and those margins can remain fat, then you see that they're able to continue seeing some price appreciation. I think it's that upward expectation and estimate revisions that we're really keeping an eye on to get there.
And specifically, just to dig in a little bit more, Anna, you noted in your recent research that earnings estimate revisions continue to trend higher, especially for value sectors. So why is this not being reflected in outperformance of these particular areas where you see growth surge ahead over the past month or so?
I think growth surgence recently has been a bit of that move in nominal yields. And what's interesting is that nominal yield move has been driven by real yields, but the inflation expectation baked in, at least the 10-year, has remained, well, rather steady. So you see this growth trade has had resurgence as yields pull back. The question for these value stocks is, is this reflation going to be a concern? And that uncertainty, I think, still weighs on it, that additional risk premium that you have to bake in. But when you look at estimates, you're right. These value sectors are really what's pushing the estimate revisions. And if that continues, and if that expectations or these revisions can continue outpacing what investors want out of it, I think you will see that eventual appreciation later down the road.
And what leads to the downdraft? You and a team with Chris Harvey looking for 38.50 on the S&P. We've had the 4,700 view just about an hour ago. What's the 38.50 view?
Well, if you remember us coming into the year, we talked about low volatility and defensive strategies come summer. And look what's happened in the recent month. We recommended a tactical pivot into low volatility strategy and style because a pullback in yields could cause some of that volatility. And for us right now, it's not that necessarily our longer term view on reflation has yet changed, but we like to say, be careful of perception becoming reality. Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control. So for us, the reason we remain cautious is that we're seeing signs of concern, and that can really have a sort of negative and spreading effect amongst investors. So it keeps us a little bit more cautious and on our toes.
Earlier this year, Anna, we were pointing to retail investors as the potential swing trader when it came to certain big moves in equity markets. Are they still players, or have they all gone back to taking vacations and not dealing with the Robinhood accounts?
Well, I think they are definitely still a player, and they may be even growing as we go several years forward. However, for now, I think a lot of the flows you're seeing and that's been dominating more in the fixed income markets has been more institutional side, has been your bigger fishes or whales in the ocean here. But when you look at equities, a lot of this sort of risk-taking or risk seeking was pulled back last month, given the additional concern about potential for full employment to be a bit further down the road. And as that risk appetite wanes, I think you may see the retail crowd be a little quieter and maybe may sit down a little bit in the stands.
Anna, good to catch up. Always good to hear from you. Anna Hand there of Wells Fargo's equity strategist with Chris Harvey and the team, looking for 38.50 on the S&P 500 year-end, Tom. Once again, framing out the story to 38.50 all the way through to 4,700 on this program over the last couple of hours.
You know, it's healthy to see this, and frankly, John, in the dead of summer, maybe that's what you see, but this isn't a normal summer. And again, I go back to maybe what we'll hear from Vice Chairman Clarida, that they are beyond data dependent. He'll phrase that in his own elegant way. But, I mean, they're hanging on every data point.
How close will Vice Chair Clarida's speech be to what we heard from Governor Brainerd on Friday going into the weekend? Lisa, I think that's the big question for this market. If we get a Governor Brainerd-type speech from Vice Chair Clarida, that's a big deal.
It means that perhaps he's aligning himself with someone he sees as being the next Fed chair. I mean, how much does that sort of
went
indicate?
Straight to the politics. I was going to the markets, but carry on.
I mean, well, the idea is, where is the balance of weight? We were talking about the big three, right? Rich Clarida, John Williams, and Fed Chair Jay Powell. Well, at this point, does Lael Brainerd become one of the big four as she starts to step to the seat?
I think anyone on the Board of Governors should be on the same page. Typically, they are. That's not my view. I think many people believe that is the case, Tom, that they're all on the same page. And that's why the speech from Governor Waller, the interview with CNBC yesterday, it was quite interesting to see him break with the core of the Fed.
You two are all Bridgerton. I mean, Lisa, you're looking at the Fed like it's an episode of Bridgerton.
I've never watched Bridgerton.
I mean, that's all there is to it.
Lisa has. Lisa, can you say this is like an episode of Bridgerton?
It is.
I don't know what you've been watching, Tom. This is not like Bridgerton at all. What's in that tang?
That is not an episode of anything I want to watch. Bond market, Fed drama. I'll take a pass. Yields higher by a couple of basis points to 119.54. Equities up 0.4%. I don't know if that's a good thing or a bad thing, Tom. From New York, this is Bloomberg.
With the First Word News, I'm Rich Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. A key Senate Republican has tested positive for the coronavirus, and that could delay the Democratic plans to pass that infrastructure bill this week. Senator Lindsey Graham and at least 4 other senators attended an event over the weekend hosted by Senator Joe Manchin. Graham will quarantine for 10 days and miss votes on the legislation. And if other senators test positive, well, that could mean they delay the vote timetable altogether. At the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and ended up winning the bronze medal in the balance beam final. That came a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're talking about a $550 billion package. Honestly, who knows where this is going to end up? I mean, the conversation changes week to week. But at this point, I think that the market's expectations for another large fiscal plan have been dampened to some degree.
That was Lisa Hornby, Schroders head of U.S. multi-sector fixed income. Thank you, Tom. You were part of that. Tom Keene, Lisa Abramowicz, Jonathan Ferro, your equity market. You're on Real TK. Equity futures up 15. We advance 1/3% on the S&P into the bond market where yields are higher by a basis point or two. A breakdown yesterday, 119.38 this morning. Still sub 120. Euro dollar, Tom, positive 0.1% and change. Euro dollar 118.89.
Yeah, we haven't talked, John, yet about the curve flattening yesterday through 100 basis points. The difference in yield between the 10-year and the 2-year over less than 1 percentage point. And, John, we didn't get down to where we were like July 17th or whatever.
No.
But I'm sorry. It's a big deal to break 100 beats.
It's odd. I mean, we've talked about this so much over the last few months.
Yeah.
Guessing the data is one thing. Guessing how the market will respond to the data is quite another and really difficult to do. It was a downside surprise on the ISM, okay. But when you broke down the ISM, really robust demand still, some really subtle signs that supply constraints were easing. Those are the kind of things we want to see. I don't know, Tom. What do you think?
Tom Purcelli wrote a note on that saying it was better than the gloom that was in part of
beneath the surface, yes, I agree.
Yeah. I don't
Short squeeze. That's what a lot of people were saying.
Is that what they're saying still, Lisa, though?
Still, which is the shocking thing, the idea that there still are shorts to be squeezed out.
That's been the excuse for the last several months. Okay. I mean, I'll go there. Your 10-year 119.38. I'll go anywhere with this bond market right now, Tom. I've got no idea.
Jack Fitzpatrick is like, what are they talking about? He's in Washington. Jack Fitzpatrick, our Bloomberg government reporter, and joins us this morning. Jack, I got to stay on plan here. There's always a wacko issue that comes in every summer in Washington. It's eviction, and I guess we can make a joke about it, but this is really serious, isn't it? Are there going to be people out on the street?
Yes, as it stands right now, there's not really much of a plan from the executive branch or Congress to deal with this. The president, speaking about this yesterday, did note that states are taking action to the extent that about 1/3 of the people who would be evicted are not going to because of their own state measures. But really, the list of things the president is trying to do in an announcement yesterday is not totally concrete, pushing states to take action, trying to get previously allocated money out. That has been a big deal. Right now, there's not an extension of the moratorium, and the Supreme Court had made it pretty clear that the Congress actually needs to act on that, and the House is done.
Well, that would be my Civics 101 is where's Congress? But is this a debate about this pandemic, or is this a debate about welfare and Washington going back to the days of William Jefferson Clinton?
This one, I think, is pretty clearly more its own issue today. It's not extremely ideological. Even on the Republican side, a lot of the criticism I heard was just that the administration sat on its hands and waited way too long to tell Congress that it needed Congress to act. And meanwhile, they tried to act to make everyone whole in these negative situations with landlords. But out of the $46.5 billion that was supposed to go out, as of late last week, only $3 billion had gone out. So just the it's really a bit of a mismanagement issue politically and in terms of spending money that Congress had allocated, much more than an ideological issue that I can tell.
Jack, I of course don't have a particular view on this. The unemployment insurance expires in September. I'm just wondering from your perspective, if there is a conversation brewing here about delivering more assistance once that does expire in September, given what's about to happen with evictions.
Well, the timing and the back and forth on the eviction issue makes you wonder, because the administration had initially said it would let it expire and then at the very last minute asked Congress to act. So that may not be a good sign for them standing by their exact plans. But the president has pointed out, and people around him have publicly pointed out, this is set to end in September. They plan to let it end. That kind of relieves some of the partisan debate that's gone on back and forth for months in Washington over what exactly the role of those benefits are in terms of the slow return of the workforce. So we haven't gotten anything specific showing that the president might change his mind on that. And I think the general expectation is that is going to end in September.
Meanwhile, we have the infrastructure debate ongoing with Lindsey Graham, the senator from South Carolina, being diagnosed with coronavirus, not able to join for the vote for 10 days as he isolates himself. He has been vaccinated. He is okay. That according to the reports, but he doesn't want to infect others. There is a question of how much flexibility there is, how much support there is with enough of the constituents to get this bill across the finish line before the recess. What's the odds, from your perspective, from the people you speak to, that they'll be able to plow forward regardless of Lindsey Graham's participation or not?
Right now, it's looking pretty good, but you do deal with narrow margins in the Senate. I'd point out the first procedural vote they took, they needed 60 votes, and they'll need 60 votes again, but they got 67 votes. I think the amendments upcoming will play a significant role. I looked through all the amendments filed as of yesterday. None of them were really controversial. At this point, they're taking votes on an untold number of bipartisan amendments that don't seem to threaten that many votes. But as you go through that process, somebody could get upset over something and you lose votes. But the fact that the starting point is essentially 67 and they need 60 is a pretty good sign, especially given that we haven't heard of anyone else testing positive. There was a party or a gathering, they said, on a houseboat. The more negative tests that come back from that, the better for them, because if a dozen people are affected, that's obviously a much different scenario. But as of right now, this kind of takes them down from 67 to 66, which doesn't look like a problem.
Jack, thank you. Jack Fitzpatrick, Bloomberg government reporter down in Washington, D.C. Tom, you're right to point out what's about to happen with evictions. We've gone through the numbers a couple of times. I'll do it again because I think it's worth it. This, according to the latest Census Bureau survey. Now this has expired. This is what's at risk. An estimated 3.6 million households who've fallen behind on their payments are somewhat or very likely to face eviction over the next 2 months. About 7.4 million households are behind on rent in total. Tom, this all according to the latest Census Bureau survey, and those numbers are just horrendous.
Whatever your politics, the inability to distribute the funds shows a level of distrust in the process. And John, it's not just evictions, it's the underlying landlords that are hammered by certain bills. And even above them, some of these smaller banks, they're not JP Morgan. They can't do it out of petty cash.
If there's a debt, Tom, there's someone not paying and there's someone not being paid. And Lisa, that's the situation right now.
The interesting thing is also where a lot of these evictions may occur. And you can actually see that it's concentrated in southern states, in particular Mississippi, South Carolina, and Georgia, where they are more likely, tenants are more likely to carry rent debt in the U.S. on average. Just looking at this, you wonder what the political ramifications are as well of those images of people being kicked out of their homes, John.
Yeah, a story that we need to stay on top of right here on Bloomberg Surveillance, on TV, on radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Up 14 on the S&P 500, advancing 1/3 of 1%. Yields are higher this morning by a basis point and change to 119.21 on a US 10-year. And euro dollar stronger, positive 0.2%. Euro dollar 118.92. From New York City this morning, good morning. This is Bloomberg. Live Live from New York City for our audience worldwide on TV and radio. Here's the price action this Tuesday morning on the equity market. Futures positive by 1/3% on the S&P, on the Nasdaq up by a little more than 1/10%, and some nice outperformance on a Russell, the small caps up by 0.7%. Coming into August with a broken consensus and a wide range of views. We've had a few of them on this program already. We've had John Stolfus of Oppenheimer looking for 4,700 on the S&P and 3,850 the view from Anahan and Chris Harvey over at Wells Fargo. A wide range of views on the equity market into year end and on the bond market too. Switch up the board, 2s, 10s, 30s. Your 10-year yield right now at 118.88. You've got Steve Major at HSBC looking for that move, that relentless move, gravity almost, pushing us back to 1%, pulling us down on a 10-year yield. Then the likes of Morgan Stanley and others looking for a move back to 160 and beyond. That range of views extends from the Southside strategists all the way to the FOMC and the Federal Reserve and the Board of Governors itself. Two very different views on what to do next. Switch up the board. You've got the view from Governor Brainerd, patience, the view from Governor Waller and President Bullard, almost said Governor Bullard then, maybe the same person. They are two very different views. Here's the view of the market right now. Financial conditions loose, loose, loose. This from Mohamed Al-Arian in the last 24 hours. And I think the Goldman Sachs Financial Conditions Index is one the Fed has got to be looking at, Tom. Financial conditions. When this chart goes lower, that means conditions are getting looser. And that is record looseness for financial conditions in this economy, in this country.
Overnight repos, John, went back under $1 trillion yesterday, but it's something to watch. You know, there's a gloom crowd, a fear crowd talking about $2 trillion overnight repos. And I don't know if you get to that number, but the answer is the financial conditions are something we've never perceived
How
before.
much support does this market need in the environment we're in right now? And the likes of Governor Waller, the likes of President Bullard, Bostic, Kaplan,
They're going to
others.
wait for the data.
Tom, they've already seen the data. As far as they're concerned, we're not in an emergency anymore. This is loose enough. Their work is done. Let's move on.
Others
Let's get the ball
disagree.
rolling. We need some optionality for 22. I'm with you, Tom. Others disagree. I mean, what did Joe Lavorna of Natixis say earlier this morning? No hike through 24.
Come on.
Hike through 24.
Okay, that's an
Compare and
outlier.
contrast that with Stephen Stanley of Amherst-Pierpont, who's looking for a hike next year of June 22. And I started this conversation, Tom, by saying no consensus one and a wide range of views. That's where we're at right now.
Yeah, okay. When do we get the dots redone? I mean, they're going to be as
Next
silly as they
meeting.
are. Yeah, you know, next time around.
Looking forward to the coverage, Tom. I can see you're excited too. Just to get through August. Let's get you some stock movers.
I want to see the data.
Here's Romain Bostic with your movers this morning. Hey, Romain.
Hey, good morning, guys. Let's start off here with Alibaba. We did get earnings out of the company. A lot of folks, of course, were focused on the company because of the regulatory overhang here. At least right now, in the short term, there doesn't appear to be a huge impact. You're talking about a company with $32 billion US dollars in quarterly revenue here, and a company that still seems to be investing in its business longer term here. So whatever regulatory crackdown is going on over there on Alibaba, on Ant Group, and the rest of the Chinese tech sector, at least for this particular company, it doesn't seem to be upending its longer-term plans. Nevertheless, the shares down fractionally here on the morning. They've been oscillating between gains and losses, now down about 0.5%. Eli Lilly taking it a little bit harder. They did come out with earnings. Those shares down about 2%. Mainly this has to do with that COVID therapy. Remember, sales in the most recent quarter dropped down to about 150 million. That's down from 800+ million in the most recent quarter prior to that. Now a lot of focus is going to be on the company's Alzheimer's treatment, which of course is still in development. This is still a juggernaut of a company. You're talking about $27 billion in annual revenue projected for the most recent year ahead here. But again, that's still a little bit light from what the street was expecting. Also coming in light here is Clorox. They reported earnings. These shares down 8.5%. This is a company that really got hit hard. Remember, they benefited a lot from everybody disinfecting and doing everything during the pandemic. Sales came in way below estimates, and they're projecting a 2 to 6% decline in full year organic sales here. This is for the fiscal year that just started in July. So this is a big deal. Keep an eye on that. Also keep an eye on Take-Two and the rest of the video game space. Last night, Take-Two did report earnings. They also missed estimates both in terms of revenue as well as in their monthly active users. This is a stock also that the company that basically came out and said they're delaying a couple of games. They didn't specify what those games are, but the shares, I know this is going to be big in the Keene household, I'm sure. Down 4% here. Activision Blizzard reports after the bell tonight, Tom. Keep an eye on that. And of course, a lot of concerns here about Tencent and whatever the heck's going on China and those reports about the video game industry there. Finally, finally, Tom, keep an eye on Lyft. That's reporting after the bell tonight here. This is still going to be a money-losing company, so don't expect any profitability.
Romaine,
yeah.
Seriously, are they going to talk about vaccinated, unvaccinated drivers? Is that on your radar for the close?
Well, they're going to talk about it, but here's what they're also going to talk about. Here's the deal, Tom. You're talking about a company that, despite the fact that they're losing money, despite all of the concerns, they're going to punch through 700 million shares. For the first time, Tom, they're going to have something like 15 million active monthly riders, however they measure that. And more importantly, Tom, they're talking about $45 per active rider. That's a big deal for this company that, of course, was below 40 just a couple of quarters ago. So they're getting more money out of their riders. So I guess that's a good thing. That means either we're riding more or riding further, or maybe the prices are higher. Who knows? But there's a lot here going on with Lyft. I tell you, most of the folks over at Bloomberg Intelligence who cover this, Mandeep Singh and that whole crew down there, they're pretty bullish on both Lyft and Uber with regards to ride-hailing, that ride-hailing business.
Romaine Bostic, thank you so much to close this afternoon here in earnings season. This is an important conversation, and it may surprise you that it's our conversation of the day. We're trying to recalibrate equities and economics into the litmus paper of the system, which is yield. And John Ferro, you've talked about global yields as being as important in their interdependencies as the U.S. 10-year benchmark.
Yeah, let's get to Parag Garvey on that, Tom. ING head of global debt and rate strategy. Parag, all this talk about 10-year yields and they shouldn't be down here in the Treasury market. Then you look to Germany, and yesterday the whole curve below zero, beneath zero. Parag, how important is that dynamic, the European dynamic, that gravitational pull, yield to lower?
Oh, it's absolutely vital. It's. I mean, this is an incredible set of circumstances, but you can't get away from the fact that the Treasury yield is the global benchmark. And as we sit here today, we're looking at that 10-year heading towards 1%. And I think the big lesson here for Europe is that Europe never really recovered from the global financial crisis as measured by monetary policy. I mean, rates are still negative. QE is as aggressive as it's ever been. The only hope for Europe is that the US manages to repeat what it did post the great financial crisis, stop buying government bonds, raise rates, get back to some semblance of normality. So what I see in Europe is a loss of hope, because if the US can't do it, how can the Europeans do it? They haven't done it before.
A loss of hope. I mean, is that the message from the $16.5 trillion of negative yielding debt, the highest volume globally since February? Is this representing a loss of hope?
You know, you've got to break this out as to whether the market discount is telling us something about the future, or whether the market is being pushed there by an excess demand for fixed income. And I think it's a bit of both. In a sense, there is a loss of hope, because we've got to accept that the marketplace, the bond market, is a discount function. But at the same time, we know central banks are huge buyers of government bonds, persistent buyers of government bonds, and that's a major catalyst behind this fall in yields. Everybody wants to be on the same side as the central bank. And as long as central banks are buying bonds, that's the side you want to be on. Hence, we find ourselves in this incredible situation, very deviant from where macro circumstances are.
Park, you know, we're all talking yield here, but this is a time where I flipped a price, and the answer is there's a massive bid on all this paper. Is it similar to 2005 and 2006, or is there a different character to the bid, the insatiable desire to move price up on fixed income?
There's a whole series of players out there, Tom, that are buying fixed income. And, you know, it's not just guys buying bonds. It's also corporates setting up fixed rate receivers where they swap from paying fixed to paying floating, because they feel that by paying floating, they're going to get the cheapest funding, and the prognosis in terms of rate hike risk is really quite dim. So what I see is an excessive demand for treasuries. We see a lot of buying out of Tokyo, for example. And, you know, I've said it before, if you're sitting in Tokyo, you don't care what US inflation is, as long as it's not affecting US yields. And that's I mean, if the simplest explanation for where we are is an excess of demand of supply for fixed income. But it poses problems. The Fed have not spoken about this, but they will not be happy to see the 10-year approaching 1%. It makes life very difficult for them.
They should stop buying tips then, shouldn't they, Parag? And we'd stop talking about real yields, wouldn't we? Wouldn't we have an adjustment there? I mean, I'm asking you the question how distorted that market is right now.
Well, the entire spectrum of rates is distorted. I mean, minus 100 basis points is an absolute distortion. 1% potentially for the 10-year is a distortion. And here's the thing, the Fed wants to hike rates. Not now, but they will want to hike rates. You can't hike rates with the 10-year at 1% because you're just going to invert the curve.
Yeah.
So they have an issue. They want to get that 10-year up to 2% ideally. The way to do that here and now is don't taper, just stop buying government bonds. Will they do that? Unlikely, but that's what they probably should do.
Porrick Garvey, it's good to catch up. ING Head of Global Debt and Rate Strategy. TK, this is the issue right now. You can say it's distortions and technicals, but eventually they become fundamental narratives. Price shapes narrative. And then this story, this theory of reflexivity starts to emerge. It's a market that shapes the weather it anticipates in many ways, Tom. And this is an issue, I think, for the bond market going forward from here.
We could get philosophical here, folks. Reflexivity is owned by George Soros back to Karl Popper. And, John, you're absolutely dead on in that it is an ex-post central bank. And then what Popper weaned in the early 1950s and George Soros picked up on is the narrative changes, and that changes your interpretation to the ex-post view. I hope I got through that in one piece.
Porrick just said it for us.
Yeah.
This Federal Reserve, even if that bond market move is just full of distortions and technicals, it could stop them from hiking interest rates because they don't want to hike interest rates if they're going to invert the curve.
On radio and TV, I can only say it is just an honor to deal with John Ferro on economic epistemology, the British way, and reflexivity.
Thank you, Tom. I'm not sure how authentic or genuine that was. Tom Keene, Lisa Abramowicz, Jonathan Ferro. Equity futures up 15, up a third. Mistraining again. He's missing. The Italians say he's found in Giorgio Chiellini's pocket. I'll leave that there. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state, and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach that many enthusiasts would like to see. He says that investors must be protected against fraud. Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. We spoke to CEO Bill Winters in an exclusive interview.
We'll then have plenty of capital to continue to invest either organically or inorganically. So if we get some interesting acquisition opportunities along the way, we'll have the capital to do that. If it turns out that there's nothing out there for us to invest in, which would be a bit disappointing, then of course we could resume buybacks or increase the dividend.
And Standard Chartered is expecting full-year income to be in line with what it was last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
As of Saturday, CDC reported the 7-day moving average of daily new COVID-19 cases to be about 72,000 cases per day. This represents an increase of 44% from the prior 7-day average and higher than our peak of last summer.
Rochelle Walensky there, the CDC director. The important component, of course, the relationship and the change relationship between those cases, hospitalizations, and ultimately deaths. We can talk about that in just a moment. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's your market up 16 on the S&P, advancing 0.4%. Yields are higher by about a basis point. 1 basis point higher to 118.71 on 10s after yields broke down through the best part of yesterday's session, the latter part of yesterday's session. One name to watch in the pre-market, Lilly down mildly. It's a mild move lower by about 1.67%, Tom. I'll just rattle through the numbers numbers, Tom, and give you the forward look as well. Second quarter adjusted EPS at 187, the estimate 189. Second quarter revenue 674, 6.74 billion, the estimate 661. Just a forward look here on revenue, Tom. Full year revenue 26.8 billion to 27.4 billion. Had seen 26.6 to 27.6. So no big moves in the mix here, Tom. Just a subtle move lower, down by 1.67%.
This is a joy, and it is a joy, John, when you are weaned out of Indiana, as part of my family was. David Ricks is with Eli Lilly, their chairman, their chief executive officer, celebrating his 25th year with the company. The Ricks era, going back to his first day darkening the door, is 12% per year. In the last 10 years, the stock is Home Depot and Apple-like, up 24% per year. It has been an extraordinary move. David Ricks, I want to talk about where you are now with COVID. There's some sensitivities here with the antibodies and that. When you're meeting with your head of research and science, Daniel Skowronski, as well, when you look back at the last 18 months on COVID and you look forward to the next 18 months with this horrific pandemic, what have you learned, and what's the to-do right now for Eli Lilly in this horrific pandemic?
Yeah, Tom, thanks for having me on, and Dan's a key partner for us. And as a science-driven company, you know, those meetings happen a lot, as we were talking offline. COVID, we've had a lot of ups and downs with COVID. You know, last year we had a lot of unknowns about how this would progress. And we set to work to create therapies, because that's what we do. We're not a vaccine company, that could be helpful. And we did that. I think we're very proud of that. We launched neutralizing antibodies, both a single and then a combo. And we also have developed one of our anti-inflammatory medications, Olumiant or baricitinib, which actually today we read out results that in those on ventilation or ECMO, the most advanced patients in the hospital, reduced death by over 40%. But we just wanted to, you know, put our tools to work to be helpful. You know, our ongoing business is about treating other diseases. We're not a virology company. And so as the pandemic has ebbed and waned, those businesses have come back strongly as treatment for diabetes and cancer has improved once doctors' offices open. You know, we don't think about ourselves as a COVID company, but we were happy to make a big contribution. And this year, you know, that ended up in a fair amount of sales. Although in the second half, you mentioned the guidance being narrowed on the year. That's really about reducing COVID-related antibody sales and increasing the performance of our underlying business. We do expect that as these waves happen, they'll begin to subside. Each one will be lower, and a new sense of normalcy will set in. Right now, we have a problem in the U.S., but you know, we think there's a way to fix it. Get everyone vaccinated.
Dave Ricks, tell me about Alzheimer's. The absolute uproar in Washington about the need for a solution, the whole FDA thing. I get that, fine. You guys going back to insulin get these horrific diseases correct. What are you going to do to help our listeners and viewers with Alzheimer's?
Yeah, thanks. This is an area that's very personal to many of us at Lilly, and our scientists have been working for over 30 years to try to create a medicine that could slow the progression of this disease. You may know this, but it's the 6th leading killer. It's a fatal disease, and it's the only one in the top 10 without a medication that slows it down. Recently, the FDA shifted their policy. They said, look, showing an ultimate benefit in a slow-moving, difficult disease that we don't fully understand has been hard to approve drugs on, but they moved the line.
Excuse me for interrupting. This is really important, Mr. Ricks. Do you support that shift in FDA policy?
So, look, the regulator needs to make that decision about risk and benefit, but of course, we believe that amyloid reduction leads to slowing of the disease. We've been betting on that for some time and put billions behind it in research, and now we have a leading product in that area, donanemab, which had the first ever clinical trial in humans read out positive in Q1. So we have launched a bigger study, and we said in Q2, we're planning to submit this year under that new policy. And we think patients deserve access to that medication, but we're going to prove its worth just in the following year. We have a huge study going on that we just said is almost enrolled and will prove that benefit.
Dave, the Biogen drug was incredibly controversial when it came out, in large part because of its price, in addition to the FDA policy, which did seem controversial even within the FDA panel. How do you plan to be different with your Alzheimer's drug in terms of the controversy, in terms of the pushback, and frankly, in terms of the price point?
Well, we're not going to announce the pricing today, but I'll just point out, I mean, we tend to compete aggressively in all the markets we're in, and that benefits patients. And we compete by creating better molecules, better medicines themselves with different properties. In this case, our medicine works very rapidly to clear plaques. By 1 year, almost the vast majority of patients in our study no longer needed to take the drug. They had cleared all the plaque in their brain. That's different from all the other antibodies being studied, which are really lifetime therapies. Secondly, we compete on data, and this is important here, and I think the source of the controversy. Few argue that the approved drug might have worth. I think the big argument is, did they prove they had worth? Did it really affect the disease? Of course, we are committed to complete the study that's now basically enrolled. We'll finish enrollment this quarter.
Yeah.
And we'll have that data in 23, which is pretty short period of time in the trajectory of drug development. And finally, we will compete on value in the marketplace. And when we hopefully get our approval sometime next year, we'll talk about our pricing strategy.
Dave, just quickly, a minute on the clock. Are you requiring your employees to be vaccinated?
Not at this time. We're not. We believe we have very high rates of vaccination in our population, but we're tracking that issue very closely. And of course, new information just released in the U.S. about the transmissibility of the Delta variant from those that are actually vaccinated is of concern. We're analyzing that as we look at our policy. To date, we've had very few, if not zero, in many of our facilities transmission of the disease.
Yeah.
And so it hasn't been a real problem for us in running our business, but we want to look at that and stay abreast of the latest information.
Dave, it's good to catch up and get your view this morning. Dave Ricks, Eli Lilly Chairman and CEO. You as well, sir. From New York City this morning, good morning. Your equity market pushing higher by 16 of 0.4% on the S&P 500. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance.
Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control.
There's always pullbacks, and mini corrections, maybe even a correction ahead.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
I'm more worried about growth in 2022, and that's what the U.S. bond market and global bond markets are sensing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's a simulcast, a Tuesday simulcast, radio and television. Esteemed guests coming up, particularly equity market. We really looked a lot at the stock market today. And John Stolfus got us going. I mean, John, take it out. 4,700 on to 5,000. That's a Dow 39,000 equivalency.
Thanks, Tom. I'm sure they've got a Dow year-end price target over at Oppenheimer too. Not. Your equity market up 16 on the S&P, up 0.4%. In the bond market, TK, you and I, Lisa too, we've been talking about this broken consensus in the bond market. It's in pieces after July and a 25 basis point move lower on the 10-year. And I wonder, Tom, to what degree, to what extent a consensus remains on the Federal Reserve as well, and whether Chairman Powell is really struggling here to reflect one that may not exist.
Okay, that may be true in economics, John, but take it back to Fibonacci 101. If the yield is telling us something and the bid up in bonds is telling us something, you flip the reciprocal, and that's how you get the Dow 40,000.
What is it telling us? Away from the Dow talk, what is it telling us? Can we agree on what it tells us? Does it tell us that the Federal Reserve has a massive presence in this market, that they hold 25% of the TIPS market? Does it tell us that the hopes for better growth through Q1 have basically been diminished by the fears of decelerating growth through the year ahead and into 22. I have no idea. You pick 5 strategists, I'll get 5 different reasons as to what's going on.
And somebody on the Zeitgeist mentioned the 10-year in Japan didn't trade yesterday. Lisa Abramowicz, your thoughts on all this, and bring it in away from full faith and credit bonds into what you're observing in IG and in high yield.
Basically, the Fed's put that has been ongoing, as Bill Dudley even said, was the main dominant factor in yields being as low as they are, is trickling over to the credit side, companies refinancing at the fastest pace ever. I think we were really framing the debate well, both you and John, earlier today when you were talking about, can the Fed raise rates and move away from their stimulus if everybody is buying into it and following them? How disruptive, Tom, will it be for them to change course if everyone is just saying, we don't want to fight you, we're on the same page with you, and that will necessarily lead to a correction that perhaps the Fed's not prepared for right now?
John, do we change the parlor game over the Fed when we see a headline that Tyson Foods will require vaccinations from the U.S. workforce? I'm sorry, that filters into our game.
Let's frame it broadly, then we'll get specific.
Sure.
We've talked about August as the path through to September. Why? Because September, we're waiting for this supply-side response, more people coming back to work, easing some of these supply constraints. That's why how we respond to this COVID variant, the Delta variant in the coming month, is so important, and that's why this headline matters more specifically to the likes of Tyson Foods, Tom. So let's rattle through them together. They're going to require COVID-19 vaccinations for the U.S. workforce. Almost half of the U.S. workforce has been vaccinated. Infection rates among team members remain low, and they've given a date, Tom. All team members required to be vaccinated by November 1st.
Okay, so
worth pointing out a couple of things: the size of the workforce and the nature of the business. 139,000. It's a big workforce, Tom. The nature of the business, when you think about that, I think this decision speaks for itself.
November 3rd, also a Fed meeting. Maybe that's a small coincidence as well. John, let's get through the data to get to our important guests. The VIX 18.70, futures up 16. Equity markets giving me a lift. Maybe small cap doing better.
Yield to 118 on a 10-year, Tom, basically unchanged. They were higher by a basis point or two. We're now going nowhere. Talked a little bit about foreign exchange already this morning, Tom. If you tell me how this market responds to the data in the bond market, I'll still have difficulty telling you how the FX market will respond to the bond market. So there you go. It's a challenge for anyone operating in financial markets at the moment, except for those that just said, you know what, start of the year, I'm going to buy an index, the S&P, the NASDAQ, and I'm going to sit there and do nothing for the year. And then let these conversations go along around me. And the Dow, if you want to as well. Lisa, I imagine there are some products out there.
There are a few
that you can buy to get exposure to the Dow index if you want to.
Oh, generous, charitable.
All right?
Yeah, very good. Joining us now on the Dow Jones Industrial Average, Michael Holland with Holland & Company and their chairman, knowing that the Standard & Poor's 500 is more indicative of what's going on. Michael Holland, I want to ask you a Louis Rukeyser question, and I say this with great respect to the sweat of Wall Street Week years and years ago when fear was ascendant. The way we solve fear in our equity ownership is to extrapolate out what successful companies do. How far out are you extrapolating right now on the companies you believe in? Are you out 6 months? Are you out 6 years?
More like the years than the months, Tom, but I think there are fewer and fewer companies that one can zero in on and say, I think this is worth the risk of losing money, because the potential for the upside is so significant. There is enough cacophony around about the economy, the Fed, China, COVID, and on, that companies like Tyson, which you were just talking about, are indicating the world continues to change under our feet. Yet in the markets, because of the tsunami of cash that has come over the markets over the past few years, we have pricing that we've lost price discovery. We've lost real rates of return to use, risk-free rates of return to use for econometric modeling. So the Fed is flying as blind as the rest of us.
Interesting to me, Michael, how willing investors seem to be just to isolate a problem. A problem emerges, they can put it over there to one side and say it won't bother us too much. And a great example of this, you mentioned China. This is what Dan Ives of Wedbush had to say. My producer Jamie pinged this across to me in the last couple of minutes. This is what Dan Ives says. We believe these dynamics will yet again bode well for US tech stocks as the favorable backdrop and rotation away from Chinese tech into US tech creates an Nirvana setup. So, Mike, we used to say a couple of years ago, what hurts some would hurt everyone because we're all buying the same basket of goods. Now we've got people saying what hurts China will actually benefit US tech. Let's rotate even harder into them. What do you make of that dynamic?
The dynamic is reflective of a market that has gone inexorably upward, Jonathan, over the last several years. And I think the looking for the positive outcome is something that I'm always prepared to do. But in the case of China, I think it would be a fool's errand to ignore what's going on. There's a wonderful piece in Bloomberg Intelligence yesterday on the terminal about the thing that's different about China today, in contrast to the last 40 years, most of which I've spent going over there, is that they now remember that they're communists. And when they remember they're communists, you end up with a situation where you're not doing things as they've been doing for the last, which created Alibaba, which created the opportunity for people to make tons of money. They're now becoming political and warrior-like.
So, Michael, fold that into an investment thesis. If price discovery has gone away, if we have China that matters more broadly, what are you doing right now?
Being very careful, and Lisa, and actually, we've kidded before about the all-weather portfolio, but I think as the three of you opine daily, there are things that don't make a lot of sense, can't be explained in terms of where prices are. You have a 5% earnings yield, the flip of the reciprocal of the price earnings model on the markets in the U.S., and less than a 2% 10-year Treasury with inflation looking like it's going to be sticky at somewhere around 4 to 5 to 6, or maybe 2 to 3 to 4. But these things don't make sense. So what I do is try to identify properties that are useful. Tom asked a question about weeks and months, or Jonathan as well. You buy properties. I would say that companies like General Motors, which I've been looking at recently in the last several months, have a plethora of things that could go right, but a valuation that doesn't reflect the overall market. So the risk, but there are fewer of those. They're just, it's hard to do.
Michael Holland, do you do some of the parts analysis on companies that have different sections? They're not Ling Temco Vote. Michael, you and I are the only ones listening or watching that know what LTV is. But if they're not Ling Temco Vote, do you still do some of the parts, say, on Amazon, Apple, or some stock I don't know?
Yeah, absolutely, Tom. It's interesting that you even have to ask the question, because that's what value is. If the three of us, the four of us, I should say, we're looking at something to buy in the private market, we'd look at what is it worth? What are we willing to pay for it? And in the public market, people have gone away from doing just what you described. Jimmy Ling and the LTV crowd figured that out a long time ago. But prices were so low back then, in a lot of cases, that you could find out that if you looked at, let's use General Motors today. If you looked at the different kinds of businesses there in technology, any individual one of those a few years from now could be worth a gazillion amount of money. But they're trying to do that to further the businesses. But yes, you do still have companies like General Motors that afford that opportunity to look at maybe some of the parts is really worth a lot more than what the market's paying for them. But not too many of them anymore.
Mike, you're a legend, and it's always great to catch up. We appreciate your time. Michael Holland there, Holland & Co. Chairman. Let's reiterate that headline of the last 10 minutes. Here's a company that's not bothered by the politics. It's looking at the science, and it's made a business decision. It's Tyson Foods to require COVID-19 vaccinations for its US workforce. The problem we have right now, Tom, tons of demand, supply problems, worker absenteeism. And a company like Tyson Foods is looking through winter and wondering what happens to their production capacity, what happens to their ability to make sure they've got the adequate supply of workers in the business, Tom. And this is how they're trying to tackle the issue.
And there's a southern cast to this out of Springdale, Arkansas, that will be part of this analysis to their November 3rd date.
Providing $200 to fully vaccinated frontline team.
There you go.
There you go. Up a third of 1% on the S&P this morning.
Yesterday.
From New York City. Good morning.
1,000.
Alongside Tom Keene. Lisa Abramowicz wants it to be 1K.
No, I didn't.
And
He
not
did.
$200. Tom said 1,000.
That's what he said
Are you
yesterday.
correct in TK?
Well, he was saying 200.
Why not?
Are you keeping
Lisa.
notes?
Yes.
Future's positive. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. Alibaba posted quarterly revenue that missed estimates. That's suggesting plans to hike spending in pursuit of growth have yet to gain traction. Meanwhile, the Chinese e-commerce giant said it was increasing its share buyback program by 50%. That's to $15 billion. PepsiCo will sell its Tropicana juice brand to a private equity fund. PAI Partners will pay $3.3 billion for Tropicana, Naked Juice, and other juice brands. PepsiCo will retain a 39% stake in the new joint venture. Juice sales have been under pressure because consumers are cutting back on sugar consumptions. And at the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and won the bronze medal in the balance beam final. That came just a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It takes markets a long time to realize that something really fundamental has changed. Right now, I think you are seeing, not just inflation data, but you are seeing inflation present in virtually every corporate earnings call that you hear about.
That was Michael Schau there of Marketfield Asset Management, the CEO. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market picture looks like this on the S&P 500 this Tuesday morning. We advanced 12 on the S&P, up a third of 1%. On a 10-year, yields unchanged at 118.05. And some updates for you. Tyson Foods coming out and requiring its staff to get vaccinated by November 1st. The McDonald's, Lisa, in just the last minute or so, they're pushing forward as well.
Yeah, they're saying that all customers and staff will need to start wearing masks again, mandatory masks inside its U.S. restaurants and in areas specifically with higher substantial transmission of the Delta variant of COVID-19. But it just shows, John, how the private sector very much leading the way when it comes to tightening protocol going forward with this pandemic.
Those decisions coming in the last 24 hours, just unbelievable to start to see corporations respond to this through last week and into this week as well. One name to look at related to this pandemic, Clorox in a pre-market down by more than 11%. I'll rattle through the numbers for you. See second quarter, or rather the year ahead, see sales 2 to 6% decrease. 2022 organic sales down 2% to 6%. Tom, it goes on, adjusted EPS $5.40 to $5.70. The estimate $7.60. It's a miss as well on net sales at $1.8 billion. The estimate $1.9. Adjusted EPS coming in at 78 cents versus 2.41. $2.41. And it's pretty clear what's going on here, Tom. Monster pull forward last year. People have still got this stuff in the cupboards. And as Lisa and I both said in the commercial break, this is the end of hygiene theatre. In a big way for many people, they're stocked down by 11%.
Yeah, 8 standard deviation move, really, in the churn that it's been in recently, it's a huge move. John, it's round trip. It's really pretty much back to where it was Valentine's Day of 2020. I mean, you wonder, are we going to see more of these?
Down 11%, Tom. Yeah, we're down to, where are we, 161.23.
Well, we will see. So there's the stories of the stocks today, and of course, all of this very much moving. Part of it moving is a technical nature of what we see in the equity markets. Jonathan Krinsky with us now with Baycrest Partners. I'll get it out. Jonathan, I love your note because you go back and you say, look, small caps, I miss that. You look at large caps, and you fall in the center. What's the value of what nobody's talking about right now, which are the stocks in the mid-cap space versus the juggernauts of the world, or all the fever over small caps?
Yeah, there's this ongoing battle between small caps and mega cap tech, and you can see it even on an intraday basis where off the opening bell, small caps will rally, mega cap tech will sell off, and then it'll flip on a dime and just completely reverse. And that battle can be seen, on the intraday charts and on the daily charts as well. But yeah, I think the mid caps are an interesting group here because they don't get a lot of attention as far as the index itself, the S&P 400, but it's been doing a bit better than the small caps, and it's a bit further along in its upside breakout. So we think, take your eyes off the small and large and look right there in the middle. There's some really good opportunities.
Jonathan, what does the technical strategy of melt up again, and melt up yet again look like? I mean, I'm looking right now at a Bank of America metric, basically saying that there is almost a contrarian sell signal based on how many people are bullish, and then even more bullish because what could potentially end this rally?
Yeah, well, that's what happens when you don't have a 5% pullback in the S&P for, I think we're going on 9 or 10 months now. And that's really the paradox of the market, right? Because on the one hand, we know that, markets tend to get at least a 5% drawdown almost every year. So, the clock is ticking there. On the other hand, in markets, when you go this long without that 5% drawdown, it tends to persist, right? We saw the entirety of 2017 go without a 5% drawdown. So we're really in this battle here, and we kind of use the analogy bull in a china shop for the current market because it is a bull market for the S&P anyway. And long-term breadth is pretty good. If you're looking at metrics like percentage of stocks above the long-term 200-day moving averages, those metrics are still really good. But we know there's this violence going on, in these rotations under the hood and on the sector level. We saw it in Chinese equities recently. Chinese internet stocks lost 55% off the top. So it's a bull market, but there's a lot of violence going on under the hood. And, we're not going to get that 5% drawdown until you see a sustained move in all the sectors, right? So we've just kind of had this push-pull where one sector will pull down, but then it'll be insulated by another sector rallying. So, I don't know what's going to cause all of the sectors to kind of move down together, but that's really what you need to see that bigger drawdown.
So just to clarify this, in a recent JP Morgan survey, almost 2/3 of clients said they plan to add to stock holdings in the coming weeks. Bulls are getting more bullish in a way that we haven't seen, as we were talking about earlier. Are you basically saying that is not necessarily indicative of complacency because of the violence under the index level, that anyone who's talking about the melt up really is ignoring some sort of distinction between stocks, between sectors?
Yeah, I think there is a bit of complacency on the passive side, right? I mean, if you've just been in the S&P 500 and the NASDAQ 100, some of those passive strategies, that I think certainly some complacency is setting in because, again, we haven't seen any real pain to the downside since last October. But I think for the average investor or institutional investor that's got a lot of different stocks, maybe different market caps, there is more of that pain and there is more of that caution. So it's almost a tale of two markets. But I think as we get, we know we've talked about all the bearish seasonals in August. We have a lot of Fed talk coming up with the Jackson Hole meeting. So I think the risk that a bigger broad market shakeout later this year is certainly increasing. And I think some of that complacency you talked about comes into this. So, again, we'll see. I think really, again, the S&P 500 is so dominated by mega cap tech that you really need to see those FANG stocks come under some pressure. And to do that, you probably need to see interest rates move, kind of scare people back to the upside again, which we haven't seen in quite a few months.
Jonathan, we got to run. It's got to catch up. Jonathan Krinsky there of Baycrest Partners. Looking at the bond market and rates, 2s, 10s, a break of 100 basis points again, back down to 99, a 99 handle on that 2s, 10 spread. That curve's flatter, Tom.
In the blur, John, I couldn't figure out the Japan 10-year story. Robin Wigglesworth over at the FT notes it's Stephen Spratt of our Bloomberg noting no trading today in the Japan 10-year. John, I don't know what to make of that. I mean...
Well, that's what happens when a central bank consumes the market.
Exactly.
And that's what's been happening in Japan. And that headline's not the first time we've seen it, is it?
Yes.
We've seen it a number of times, Lisa. These markets... Can we even call them markets anymore
No.
in the
I
traditional
was
sense?
Just going to say the same thing. Is it a market if you have one behemoth in there just sticking its thumb on everything?
On everything. Price-insensitive buyer, sucking it all up. What does the 10-year tell you?
Who knows?
117.55. I mean, the answer at the moment is who knows. Got no idea. Your 10-year unchanged at 117.55. 2s, 10s breaking down sub 100 at 99 basis points. From New York City, Tom Keene, Lisa Abramowicz, Jonathan Ferro. For our audience worldwide on radio and TV, this is Bloomberg Surveillance. Live from New York City for our audience worldwide. Good morning to you all on TV, on radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. This Tuesday, here's the price action in your equity market. The S&P 500 pushing higher by around about 6 points, up a little more than 0.1%. Off session highs on the S&P. The Nasdaq 100 also up 15, call it 16 points higher, positive 0.1%. Outside of that, bond yields unchanged on 10s at 117.39. It's a shift higher by about half a basis point on the front end on the 2-year, and a shift lower on the 10-year, also by about a half a basis point. That's taking 2s, 10s down by a full basis point, which means, Tom, that gap, that spread is narrower to 99. It's just a really small move. Half a basis point on 2s higher, half a basis points on 10s lower, down a basis point on the curve to 99.
It is a splitting of hairs, but nevertheless, it's a benchmark. 100 basis points, a difference in yield of 1%, and to be beneath that is something I guess we'll look at. You know, the rest of the market may be churning and looking for ADP and then claims and then on to the jobs report. James Sweeney joins us now with Credit Suisse. Always 14 things to speak of. And to the chief economist at Credit Suisse, I must ask, James, how you formulate 1.1 million jobs on Friday. How do you derive that statistic?
It's a little difficult right now, but it's definitely causing us to put more attention on the non-seasonally adjusted than the seasonally adjusted number. There's some hints that some of these, what we call NSA numbers, have been a little more stable than the seasonally adjusted numbers. I don't know how exactly seasonal factors that include 2008 and 2020 in them are expected to work. So we think you lost a little bit of the jobs numbers from some of these adjustments a few months ago, and you're going to get them back this month.
James Sweeney, there's some mathiness here of the standard error. We're not going to go into it right now, but nevertheless, we observed the standard error of the April report on May 7. Do we have a same standard error exercise this time around?
I mean, I think it was bigger a few months ago. I think the data fog is starting to break, but it's not broken. So, I mean, in the initial return to work phase, it was particularly hard to forecast these numbers. It's still hard. It's not quite that hard. The most important variable, though, of course, is not payrolls in a given month with a big standard deviation, but what's the underlying average net jobs growth we're going to see over the next 12 to 18 months. And given that any individual month is so hard to forecast, you know, we also have to really think about where's the unemployment rate, where's the level of employment going to be in 12 to 18 months. And that's pretty difficult. I mean, if we're off by 500,000 jobs, you know, that could be the difference between getting a Fed hike or not in a given quarter. So economists are going to need a little bit of patience and sympathy, because we cannot really compare this cycle to previous cycles.
You asking for patience and sympathy, James? Sympathy and patience. Tom, James Sweeney wants sympathy and patience from us.
He does. You know, he's a sensitive guy.
Are we going to give him some?
Yeah, absolutely.
Good luck, James.
Let me ask you this question, James. Who do you think has the most support on the FOMC right now? Governor Brainerd or Governor Waller? Bit of disruption on the line, I think, there, James. I think you can hear me and then back through the microphone again. James, take a second. We'll re-establish that. I'll have some patience, a bit of sympathy, and we'll wait a couple of minutes. We'll come back to you. I think that's a key question right now. You've got the views of Governor Brainerd on the one side. Governor Waller coming out on CNBC yesterday with some views of his own. Governor Brainerd saying, let's wait for the September data. And then you've got the likes of Governor Waller, Lisa, who's basically turned around and said, if August is good, if the September numbers looking back through the month of August is good as well, going through September to that meeting, we're all go.
The margin of error is so difficult to get right now, especially when you get Stephen Stanley coming out and saying it's one of the tightest labor markets he's ever seen. And then you have the likes like Joe Lavorgna of Natixis coming out and saying that we're going into a very slow growth environment akin to what we've seen previously. How do you parse the difference between the diverse views here, John?
Supply side. How the supply side of this economy responds, critical. That's going to shape everybody's views, and September's really the starting point for that. And Tom, we mentioned Tyson Foods. I think Tyson Foods is a part of this story as well. They're trying to insulate the workforce from what they think could develop, maybe develop, going deeper into winter. Worker absenteeism, it's been a problem. We've got robust demand in this economy. We want to see supply start to meet it. And if we start to see an extra layer of restrictions, Tom, that keep people from coming back to the workforce, that's a problem. That's a big problem. You led earlier this morning with the participation rate in America.
Yeah.
That's what they're waiting for.
That's what they're waiting for, John. Thank you. And that was critical. And that was the core participation, not fossils like me, but cut and chiseled like Ferro, 25 to 54. And John, that's the heart of the matter. Yeah, it's improved, but it's nowhere near socially where it has to be for Chairman Powell.
So when Stephen Stanley of Amherst Pierpont, Lisa, says this labour market is tight, are we taking a view that that participation rate won't recover? Is that the view that underpins the call that this labour market is tight?
He was talking about some of the temporary factors keeping people out of the market, right? He was talking about the fact that people were concerned about childcare, having to be home. There were people concerned about the virus. And how much does that persist for a longer period of time, John? Perhaps we ought to be asking that, given the surge in Delta variants. But, you know, you ask a good question. We still don't really know the answer in terms of participation rate.
James, I'm hopeful that you have some sympathy and patience for our technical problems. James Sweeney, Credit Suisse chief economist. James, just to come back to you, the question I asked, who do you think's got the most support on the FOMC right now? The views of Governor Brainerd or the views of Governor Waller?
I think the views of Governor Brainerd right now, at least as we have not had an announcement yet on the new appointment. It would be interesting if Powell were reappointed in the next few months, if we'll see a slight shift because the doves weren't nipping on the heels so much. But I think right now the language from the core of the committee, the governors in Washington, is pretty clear that they are not rushing to taper. I think it'd be very sensible to reduce the mortgage purchases as soon as possible. But that's not a signal they want to send out. And really, we're talking about tapering in Q4 versus Q1 at this point in this debate. It's not such a cosmic big deal at the moment. They're still many quarters away from an actual hike.
James, do you agree with Stephen Stanley that this is one of the tightest labor markets that you've ever seen?
I mean, I think labor supply in the short run is very tight, and so the labor market is tight. That I've ever seen, I mean, my age, yeah, maybe. I mean, I think the late 90s had a tighter labor market than this. I would not say that 05, 06 had a tighter labor market than this, but we haven't really had an extremely tight labor market since before that. I mean, the late 90s was somewhat tight. You had macroeconomic margin pressure from labor costs, but it was being offset by strong revenue growth and strong nominal GDP growth at the economy level, 98, 99.
Yeah.
So you really have to go back to the 80s and before where you have something more pronounced. And I don't think we're quite at that level. We just have very special factors relating to the pandemic. I do think that structurally we are moving towards a tighter labor market with better persistent wage gains for lower wage workers. I hope that's where we're heading. I think that's where we're heading. I think that's where policy is directing us. But that's a little different from the pandemic, and it's going to take a few years to truly see whether that's the case.
James, John asked the question rightly earlier, and I'm sure that I completely bungled the answer when he said, well, what do you make then of this low participation rate, given the fact that so many people haven't come back into the market? How can we say this is such a tight labor market? I don't know. I fumbled around. Can you give a better answer than I gave, please?
Well, I mean, the labor market means a tight labor market means there's upward pressure on wages. So a supply restriction, even if it's only going to last a few months or a few quarters, can give us a tight labor market where wages in certain industries go up. In leisure and hospitality, they appear to be having those issues at the moment, and wages are rising. But I would separate that kind of short-term high-frequency factor related to returning to life in the end game of a pandemic from the structural situation. And if we go back to 2019, there were signs of a somewhat tight labor market for the first time in many years.
Yeah.
And I think when this thing is over, we're going to be back in that. So it's not going to be as tight and as acute as we are now, but it's going to be profoundly different from what we got used to in 2017 and the many years before that. And I think that's very important.
James, just to conclude, this is such a delicate balance for the Federal Reserve going into year end. If these supply side issues persist into year end and we have 12 months of the Federal Reserve saying it's still transitory, it's supply side issues that will heal, don't they risk this becoming part of what Fed Chair Jay Powell himself has said? It becomes part of the inflation process the longer it goes on, doesn't it, James? And I just wonder, even if it is just a supply-side phenomena into next year, how the Fed responds to that.
Well, it would be part of the inflation process if you get that, if the supply problem is really acute. But keep in mind that by definition, that means strong wage growth for a lot of lower wage workers. So workers who are choosing not to enter are an issue for the growth rate of the economy. But workers who urgently need to enter and are seeing strong wage growth. And I'm not sure that is going to be a major macroeconomic problem. So it will be disappointing growth, but it will be wage growth. It will be strong income growth for a lot of households. And eventually some of those displaced workers who are choosing not to work may come back. So, it's not necessarily the worst thing in the world if we get this, because the jobs are there.
James Sweeney, good to catch up, sir. As always, at Credit Suisse, the chief economist, James Sweeney, there on the current situation in the US economy. Every day, Tom might mention a man named Harry. And if you have no idea what Tom is talking about, Tom decided he supports a club in North London called Tottenham Hotspurs. And their best player is called Harry Kane.
He's okay.
And Harry Kane's threatening to leave. And Tom, we have an exclusive coming from the Daily Mail that Harry Kane is isolating after jetting home from a break in the Caribbean and can only return to training with a negative COVID test at the end of the week. So he's missed training the last couple of mornings. A lot of speculation about why. Maybe he was pushing a transfer, Tom, to perhaps Manchester City. The Daily Mail says he's isolating after a vacation.
Thank you.
We've cleared that up. Okay.
We're still going to be talking about it. You think that we're not going to talk about it?
No doubt we'll be talking about that through the next couple of weeks. Coming up on the Open, Wei Li of BlackRock, Global Chief Investment Strategist, not on Harry Kane, but on this market.
Parcheesi. She plays Parcheesi. Wei Li grew up.
I'm not going to ask her, Tom.
Great.
Ask her. Shock. Yeah. Lisa Abramowicz, Tom Keene, Jonathan Ferro on radio, on TV from New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach many enthusiasts would like to see. He says that investors must be protected against fraud. And Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. We spoke to the CEO, Bill Winters, in an exclusive interview.
We'll then have plenty of capital to continue to invest either organically or inorganically. So if we get some interesting acquisition opportunities along the way, we'll have the capital to do that. If it turns out that there's nothing out there for us to invest in, which would be a bit disappointing, then of course we could resume buybacks or increase the dividend.
And Standard Chartered is expecting full-year income to be in line with last year. KKR has crushed its fundraising record by bringing in $59 billion in the second quarter. It was driven largely by the initial closings of the latest North American buyout fund, Global Infrastructure Fund, and Core Private Equity Fund. KKR's managed assets nearly doubled from a year ago to $429 billion. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Different about China today, in contrast to the last 40 years, and most of which I've spent going over there, is that they now remember that they're communists. And when they remember they're communists, you end up with a situation where you're not doing things as they've been doing for the last, which created Alibaba, which created the opportunity for people to make tons of money. They're now becoming political
Michael Holland on China, the changes in China, and of course that folds into all of American technology, and that includes a team from Cupertino. Dan Ives joins right now. I'm very much bullish on Apple and other tech stocks with Wedbush Securities. Dan, I know that Lisa's got some interest in the China story. I need you right now to reaffirm 185 and how your path gets out to 200 and 250 on Apple. And the major thrust I have is in this pandemic, in securities analysis, how far out can you extrapolate the Cupertino experiment? Do you go out 6 months? Do you go out 18 months? Or do you have a terminal value out, say, 3 years?
Yeah, well, when I'm looking at 185, and I do believe that could be conservative as this all plays out, it's really some of the parts. I mean, the services business, called $70 billion annually, I think that starts to get to $80-90 billion. That's worth $1.5 trillion. That's services business. And then ultimately the hardware business, the iPhone, given what we're seeing on the growth on the super cycle, I know it's worth another $1.5 trillion. I think we have a $3 trillion market cap a year from now.
Within this optimism, Dan Ives, is the great miscall of everyone, including me, and that has been margin resiliency. What have you learned about technology in America and their ability to sustain margins?
I mean, that's really been one of the key parts of the story over the last few years. Their margin expansion, both from a manufacturing perspective, but even from a price perspective in terms of what they're passing to the consumer, has really been jaw-dropping. You're continuing to see those margins flow to the bottom line, and that's why they're generating, called $60-70 billion a year of cash. And that's going to continue to happen. Ultimately, I think we could be at $100 billion as we look out 2 to 3 years. That ultimately is why this continues to be a renaissance of growth in Cupertino.
All right. The path to a $3 trillion market cap, that's about $600 billion more than it is now for the Cupertino experiment, as Tom calls it. This really leans on growth in addition to just services revenues and other streams of profit. And part of the growth has stemmed from China. How do you partition out their presence in China at a time when the tech war between China and the U.S. is heating up?
Yeah, and for Cook, that's really been probably one of his best achievements, that they've been able to navigate this U.S.-China cold tech war for a company that produces all their iPhones in China and 20% of demand is in China. But the one thing you have to remember, they are one of the biggest employers in China as a country on a peak iPhone cycle. And from a demand perspective, and this is really the crux, they continue to accelerate iPhone demand and purchase cycles within China. And that's really been the key to the Apple story.
Dan, we're talking about this on a day, yet another round of regulatory crackdown, or at least the perception of it, in China on big tech. There was a state-sponsored media article about the opium of video games and the concern that they have around kids spending too much time on them. We also talked about, we heard about a crackdown on auto chip manufacturers in that country. How do you parse out how much this will affect U.S. companies operating in China, as well as the fund flows into big tech more broadly throughout the nation, throughout the world, frankly?
Yeah, it's a great question. I think when it comes to Apple and Tesla in particular, they continue to be more Teflon-like in terms of how this is going to impact them. Remember, China, the regulatory crackdown on Chinese companies domestically, we've seen it from Alibaba to Didi and others. We believe money is massively rotating from Chinese tech to U.S. tech. It's hard to own Chinese tech today. You don't know what's going to happen on the regulatory in a given 24 hours. This is going to further drive U.S. tech stocks. It's our view 16,000 NASDAQ. And it's just been a black eye for Chinese tech stocks, and as these things continue to come out of left field.
Dan, as the hallmark of Apple, the distinction, rather, has been their use of cash. I look at Michael Pachter's work at Wedbush on Amazon, and there's some other tech stocks as well. But is the tone of Apple on share buyback and even dividend, is that transferable to techie companies that have never done big share buyback and that don't have a dividend?
Yeah, well, I think if you look at Apple, I mean, they've been pretty clear about their capital allocation. I mean, really going net neutral, and that's why they're going to continue to spend $100 billion on buybacks. But also, the difference between Apple and others, they're not acquisitive, right? Many, and we see with Square and others, tech companies are acquisitive. Apple has not been, and that's part of that DNA of Cupertino to build it themselves, and that's how they become at the top of the heap right now, really across every company.
Dan, before we let you go, you have been a big bull on Apple, on big tech in the United States. You have been right again and again. What would you have to see to start perhaps rethinking your call?
I mean, for me to rethink the call, the digital transformation story would have to be significantly go the other way. We'd have to start to see significant reduce in spending across enterprise, across consumer. But right now, Lisa, we see the opposite. I believe we're only in the middle innings of a tech bull cycle, given all of our checks. And that's why, to me, it's a green light to own U.S. tech across the board going the second half of the year.
Dan Ives, thank you so much. With Wedbush Securities this morning. Lisa, I look at the news flow today and the individual stories along with the greater view as well. And it's just this COVID news flow centering around vaccinations, centering around what government officials are doing. And you mentioned it earlier. I mean, the basic idea here of August 3, get out the calendar, kids back in school.
Yeah, and the question is, can they get back to school in person consistently without any further disruptions? As you start to get masks being mandated in more places, as you start to get the Delta variant surge that's actually transmissible even among vaccinated individuals. Look, I think we can't overstate how important it is for kids to get back to school. I am talking on a personal level, but I'm also talking on a social level, Tom.
Yeah, and the answer is maybe that's where you solve masks. I mean, we may have masks at selected stores. We may, I walked in I don't know where it was last night. I walked in some place where I felt like an idiot. I didn't have a mask.
No, I know. Right now, you need to have a mask when you go into places. And I will tell you that my kids actually just went back to school, don't ask, very early. And they all are wearing masks. They have to wear masks in the classroom.
You are so pushy. You are so rushing your children. What do you got them doing? Linear algebra here? The early program.
I'm having them do my expenses for work. When we go out to some random, I don't know, where do you go? You said you go to McDonald's. Right.
Well, yeah, we go to McDonald's. And
where they mandate masks now. No, look, I think that the other thing...
If I keep it under $19, I don't have to, show a receipt.
I think that, honestly, though, the idea that private companies are taking the lead here is really interesting.
Futures up 9, a little weaker than what we saw earlier. Futures make a 10. Dow futures up 91, I should say. Good morning, John Farrow. The VIX back above 19.09. Please stay with us through the day on Balance of Power. The gentleman from Columbia, Dean Hubbard. Good morning.